person will go, and then at the end of the day, he will have a problem because he didn't learn that aspect that covers the Ghanaian tax law, which is a big problem. Or what do you guys think? Because why don't you study the Ghanaian side of things? Okay, why don't you study the Ghanaian side of things? They hardly go, and then at the end of the day. All right. I hope that is clear.
Yes.
Share my screen so that we go through these things I'm talking about. Trying to share my screen. So you go to the exam, you must learn everything, right? Not just facts. Everything must be learned. You must learn every single thing, right? Then you understand international taxation better, okay? So I'm going to give you a simple outline of the international taxation syllabus, okay? Then I believe you will be good to go, all right? So who can summarize what I said about international taxation before I share my screen? Let me bring a blank screen. I said something about international taxation.
You said the interaction of our local laws.
Interaction of our local law.
Because of our tax laws with other tax laws.
Okay. And I also said something. I said part of our tax law that deals with what?
International transactions.
Okay. International transactions. So there's a part of the Ghanaian tax law that deals with international transactions. Are we okay? So I am going to look at the syllabus. Then I will give you my own syllabus, right? So that's the difference. We will watch the syllabus together, and I will give you my own syllabus as well, right? So that's the difference. So let's kindly go into it. If you can see my screen, you tell me. All right. So here we are. So what is the main objective of this paper? This paper exists to tell us something, right? So we need to know the detailed syllabus. I hope my screen is visible to everyone.
Yes, Bill.
All right. So one, the objective of this paper is to understand the principles, theories, and techniques of international taxation. B is to understand the interaction of the Ghanaian tax system with other tax jurisdictions. Is that not what we just talked about? I believe so, right? To apply the principles, theories, and techniques of international taxation to practical solutions, and to solve unstructured problems, we draw on the interaction of the Ghanaian tax system with other tax jurisdictions. So if you look at international taxation in a broader sense, okay, the syllabus introduces you to international taxation. What is international taxation? That is the definition of international tax, the evolution of international tax, how international tax came to be, the importance of international taxation, and what we call policy objectives. Now, every country has some, what do we call it? Some right to make its own laws, administer those laws, and take money from people. True or false? Every country has. Now, that is what we call tax sovereignty. Okay, so we say sovereign states must have the ability to, make their own laws, right? Administer those laws through administrative machinery, or what we call tax administration, and finally take money from citizens or whoever it is. And that is what we call what? Tax sovereignty. You must be a sovereign state to have that power, right? And because of that, there are some policy objectives people put in place to make sure that these things are finally what? Achieved. So from there, we have to look at the primary and secondary sources of international tax, okay? We look at the primary and secondary rights of countries to charge tax. We look at taxing rights of countries and constraints on these taxing rights, international tax planning and forms of business organization. So For instance, if you come to Ghana, should you set up as a sole proprietorship? Should you set up as a partnership? Should you set up as a company? And what are the tax issues around it? Do you get it? Then the challenges of e-commerce on international taxation. We all know that now everybody is trading online. But do you know what the main problem is? Can you really tell if I'm trading in Nigeria or I'm trading in Ghana? It's difficult, right? Because I'm online. Do you get it? Now, that is bringing what we call the problem of nexus. Anytime you hear nexus in taxation, it makes connection. Remember that if you are in Ghana, we can tax you because you are in Ghana. What if I'm trading online? I have my hosting in US. I have some server in Saudi Arabia. It's difficult to trace where I am. Okay. And because of that, people are using the digital economy to steal a lot of revenue. So multinationals have identified this. So they always have what? An online presence to sort of what? Hide what they are doing from the tax authorities. Do you get it? So we'll dive more into the taxation of e-commerce later, but it's a new area. Almost nowadays, almost every day, something may pop up from here. Okay. Then once you understand this is like the basics of international tax. Then the next area is to look at jurisdiction to tax. We should look at who a resident is. We should look at personal jurisdiction, impersonal jurisdiction for individuals. We look at definition of residence in relation to a natural person, the physical presence test. That means sometimes you have to stay in some states for some number of days or some number of months or whatever you call it, depending on the law. We call it the rule of thumb of residence, right? Mostly it's 183 days. Then we look at residence in respect of persons other than natural persons, which is companies, right? And other entities. Then we look at trading in a country versus trading with a country. We look at how to deal with branches and subsidiaries, residence versus source principle, dual residency and changes of residency, tax havens, and the issue of preferential tax regimes. This area, in simple terms, we can call it anti-avoidance provisions, right? And this is also a big area. Okay, so your syllabus is very broad, but if you look at it like this, it looks complex. I will simplify it for you after we look at this, right? So we look at the taxation of non-residents, okay? And we have to look at non-residents and their taxation on inbound transactions and on foreign transactions, taxation of the income of non-residents that have been derived from, brought into Ghana and accrued in Ghana, source rules for income and expenditure, taxation of business, employment, and investment incomes, the concept of permanent establishment and how to attribute profits, departure taxes, tax claims and exit tax mechanisms, the methods of collecting taxes from non-residents, and ring fencing activities for tax purposes. Okay, so these things, as you see it in the syllabus, they look so complex when you see them, but they're actually simple concepts. Then from there, we come and look at how to deal with transfer pricing. So transfer pricing is a very broad area. So we look at globalization, multinationals, and tax-based allocation. We look at the arm's length principles, who are associated persons, transfer pricing adjustments, how to eliminate double taxation, the arm's length range. We look at comparability and comparability factors. We look at transfer pricing documentation. We come and look at what? Advanced pricing arrangements, intra-group services, transfer pricing methods, profit splitting, adjustment to reported income, and prevention of double taxation, adjustment to profits. We come and look at intangible assets, cost contribution arrangements, how to avoid and resolve disputes in transfer pricing, dispute resolution procedures, and finally, we come and look at what? Double taxation. So double taxation is a major theme, and that's what we'll be starting with today. When you understand this, I think they didn't arrange it well in my perspective. When you understand it from this point first, everything else makes sense, right? Then we look at other issues in international taxation. These areas nowadays, they feel like they are more specialized, so they hardly bring questions here. Do you get it? But something like global challenges and global innovations, digital AI revolution, and those things, yes, they can examine. Corporate tax competition, yes, they can. Money laundering issues, hardly do you get a question here because this is more of investigative and those things, right? But when multinational companies do business, you see there's even ethics of tax evasion in international tax. Hardly do they examine these areas. Do you get it? So I'm going to give you a good roadmap. Instead of letting this syllabus scare you, I'm going to break this down for you. For me, I like to break everything I teach into 5 questions, question 1 to 5. Do you get it? So that you are very comfortable. Is that okay? Do you have your pen and your writing pad available? Okay, so let's look at international tax from my perspective, right? International taxation from my perspective. So international taxation. Okay, so let's say question 1, the focus is on what? Double taxation and its connected issues. Have you written it down? So double taxation and its connected issues. Okay, so here, what you are going to look at is you are going to look at international taxation in general, right? What international taxation is. Then we come and look at what? The policy issues in international taxation. Okay, so there are some policy issues or some problems that occur. That is why you are learning international taxation. All right. Then you come and look at double taxation. So double taxation is a broad area. Okay, so double taxation and its issues, meaning you have to look at the forms of double taxation, the causes of double taxation, the principles of what? Residence and source. Okay. So once we know this one, we come and look at how to eliminate double taxation, right? So elimination of double taxation. Okay. So after looking at the elimination of double taxation, which is the methods of eliminating double tax, meaning we can use unilateral methods. So unilateral methods is where you reduce taxes by the provisions in our own law, right? So where we use the provisions in Act 896, the Income Tax Act of Ghana, specifically, we can make reference to something like Section 111, subsection 2. We can make reference to Section 107 for exemptions and Section 112 for the credit method, right? Then we have what we call bilateral means. So you can eliminate double taxation through bilateral means or the use of DTAs, double taxation agreements or double tax avoidance agreements or double tax treaties. Okay, so these are various ways we eliminate double taxation. Okay, so this is a major topic that every day it will pop up. Something around double taxation will also pop up. Then from there, the next thing we have to look at is our good friend DTAs. Okay, so DTAs are broad because almost everything that we'll be dealing with will be using the DTAs. So with DTAs, we are first going to look at the scope or what DTAs are. Okay, so what DTAs are. So looking at what DTAs are, we are going to look at what the classification of DTAs. Okay, how do we classify DTAs? So DTAs can exist in two main ways, either based on scope, like what it should cover, or based on the number of parties to the treaties, right? So this is how I classify DTAs, or in the world, this is how DTAs are also looked at, right? Then we come and look at what we call model tax conventions. Like before a DTA comes up, right, we base it on some particular framework. These are the frameworks that we use to come up with DTAs, or we use to formulate this double tax agreements. And we will take a look at how the DTAs look like. I'll show you an actual DTA and you look at how it looks like, right? So these model tax conventions, we have three main. We have the OECD model, the UN model. The OECD model is mostly for developed countries, and the UN model is for developing countries. And then we have the US model, which is mostly for countries which enter into double taxation agreements with the United States. But Ghana does not have any DTA with US, so we only focus on this one and this one, right? So the UN model favors developing countries. So you see most of our DTAs are based on the UN model, the one that Ghana deals with another one, developing countries. So when you look at Ghana and Morocco, you see that they have options, right? So there are a lot of them that we look at. Okay, so from there, we have to look at the objectives of DTAs, which you can use for the advantages and disadvantages of DTAs, right? We look at DTAs and the domestic law, right? So we look at DTAs and the domestic law. Then we look at the creation and termination of DTAs. Okay, so DTAs have a way they are created, okay, and then they have a way they are also what? Terminated. So that's actually the life cycle of the DTA, all right? So everything that I say is purely examinable. My approach to teaching is exam focused. So anything I feel would never be examined or hardly would it be examined, I wouldn't include in my syllabus that I'm giving you. Does that make sense?
Yes,
I
sir.
hope that makes sense. So if you are done, we proceed to the next level. Okay. So let's go to question 2. That ends question 1. So let's go to question 2. Question 2 is actually the DTA itself, provisions in the DTA, right? So we are going into the provisions of the DTA, right? The provisions of the DTA is what we are going into. But then our question 2 will first come with definitions, okay? So definitions. I forgot one thing under the question 1. Let's call it entitlement to treaty benefits. Please add it to it. Entitlement to treaty benefits. Okay. Then definitions. So under definitions, we have to look at some articles of the DTA first. We have to look at Article 3, which is general definitions. Okay. Article 3, which is general definitions. We have Article 4, which is residence. And these are very important articles, residence. And then we have Article 5, which is permanent establishment, right? So we have to look at all this. Okay, these are the main areas. And now I think we can go for it to add the digital economy because mostly you have PE from the perspective of the digital economy. Is that okay? So for me, this is my question 2. All right. Very important. It means that you can't go to the exam without this. Okay. Very, very significant. I think now when you use the word important, people don't take it important. So let's use the word significant, right? Very, very significant. It means that you cannot do even the other articles without these articles. You cannot deal with a DTA if you are not a resident of either contracting states. Makes sense? So you definitely need residence. You cannot do other articles if you don't know how to deal with permanent establishment. That is how these things work. Do you understand? And now everything is around the digital economy, the definition of permanent establishments and the digital economy. So you really have to take this very, very serious. I hope that is fine. So put it down. And then let's look at the way forward. Please, are we done now? Can we move? I should make something clear to you. You see these articles that you are seeing. If you haven't mastered them, don't make a mistake of setting international taxation. What did I say? If you haven't what?
Mastered them.
If you haven't what? Repeat it. If you haven't what?
If you have mastered them.
Don't make the mistake of setting the international taxation paper, because you will only be worrying yourself. Do you understand? Because this is like the basis for international taxation. Are you done with question 2 now? Can we move? I hope you are enjoying the roadmap. Can we move?
Yes, please. Yes, please.
Yes.
So we go to question 3, and question 3 is very broad, so I'll use a different color for it. The red ones are very cheeky and important. So question 3, let's call this the taxation of income, right? So the taxation of income, very broad. So this one starts from, we've seen article 345. So the taxation of income, I will break it into 2. Okay, so we have the taxation of active income. So I believe everybody knows the difference between active income and passive income, right? What's the difference between active income and passive income? Yes, my people. Please, we don't have time, so just go quickly. Active income and passive income. What's the difference? Generating, like your employment income, you work and they pay you monthly, right? It is active income. Your business income, you work and you generate it, right? It is active income. Does that make sense? Does that make sense? Passive income is income you do not directly work for.
Investment income
So
is
income
passive.
directly what work for. So that means you are sleeping and the money is generating. So incomes that are accrued to you, maybe in a bank account, in an investment. So mostly investment incomes are mostly what? Passive, right? They are passive in nature. You are not directly involved. The ones you are directly involved are what? Active. And the ones you are not directly involved are what? Passive in nature. All right. So let's come to active income. So active income, the articles I will talk about, we'll first start by looking at the most important article, which usually goes with Article 5, right? Article 5 has a lot of connection to other articles. It's what we call Article 7. So Article 7 talks about business income or business profits, right? So we have to look at this. Then we come and look at Article 8. Article 8 is for international traffic, okay? Very nice article. So international traffic, or people who are into the business of international shipping and air transport. Article, let me see. And let me go 13, 14. Article 14, which is only in the UN model, okay? So this one, in the OECD model, it is classified as business profit. So this is the income of independent contractors, right? So independent personal services, okay? Then come and look at Article 15. So Article 15 is employment income, or what we call dependent personal services, right? Employment income, international employment income. Then we look at Article 16, which deals with directors' fees, okay? So when you're a director in a company and you are paid board fees, how do you deal with it, all right? So I've segregated it so that it makes it easier for you. Then we look at Article 17. So Article 17 deals with entertainers and sports persons, right? So entertainers or artists and sportsmen, right? Entertainers and sportsmen, athletes, right? Okay, and how to tax them. If Sarkodie goes to perform in the UK, how much will he be paid? How will the UK tax authorities tax him? Okay. Then we look at Article 18, which is on pensions. We will look at Article 19. So these articles, hardly would they examine it on their own, like this 18 and 19, they'll be part of a big question, right? Directors' fees too. Hardly will you see it on its own as a full question, but to be part of maybe an employment income question, okay? But the other ones, they can be examined as a full question on their own. So we have Article 19, which is government service. So I'm giving you anything that is active in nature, government service. When you work in the employ of government, like you're a government official, these articles, you can use it to. Then we have what? Article 20. Okay, so Article 20 is for students. Okay, maybe you are a student, you are Ghanaian, and then you go to the UK, and then you are a student there, and you are getting some allowances from Ghana, from your parents, from your office, and then you are also employed there. So students, and also I'll give you teachers as well. So we'll also learn how to tax teachers or professors. All right. Then we come and look at Article 21. That talks about other income, okay, other income. And then I think these are the active income. When it comes to passive income, the first one I'll talk about is under Article 6. This one too, you'll not get it as a full question on it, or mostly mixed as part of some residence question or something. This is issue of immovable property. Okay, so if I have a house and I'm receiving money from that house, or agriculture and forestry, and I've rented it out, the rent income is dealt with under what? Immovable properties. Then two, we'll learn the big three, right? So we'll come and learn the concept of beneficial ownership. Okay, so this one is not really under any article. We'll learn the concept of beneficial ownership, very important. If you know this concept, then you know passive income, right? So when we learn beneficial ownership, we must learn the concept of treaty shopping. Okay, then we learn Article 10, which has to do with dividends. Okay, these things, if you don't understand what I've put up there, these two things, you cannot understand this very well. Then we have to look at Article 11, which has to do with interest. You have to look at Article 12, which has to do with royalties, right? How to tax royalties. Then we come and look at Article 12A. This is only under the UN model, right? Under OECD, it's still captured as royalty. So these fees for technical services. And the question, I think Article 13, right? Which is on capital gains. Then finally, high taxation of capital. Though capital is on its own, I like to just include it as passive. So question 3 is a lot, but actually there are some similarities in the taxation. The whole thing about taxing income is knowing which country gets to tax it first and who gets to either reserve his taxing right or tax it. So the whole thing is that anytime you make an income, you have two countries, right? The country you are coming from and the other country you went to trade in, which is the source state where you generated the money. And both countries may have a taxing right on your income. Either both of them are supposed to tax, only one of them is supposed to tax, or something else is supposed to tax it, okay? So there are four types of taxing rights. We have the primary taxing rights, we have secondary taxing rights, we have exclusive taxing rights, okay? We have reservation of taxing rights. So it depends who is taxing first, who is taxing second, who is not taxing, who is exempting you. So it depends, right? And these articles is just telling us these various categories of income and which country should have a hand on the income first, second, or not tax it at all. Have you put it down? I hope you are learning something as we go by. If you can't see my arrow, kindly prompt me and I'll mention it for you. So put it down. And now you see the things that you are seeing here, it is being simplified. Have you noticed? Have you noticed?
Yes.
Please.
Right.
What about management fees?
That is what we call fees for technical services. Consultancy fees, management fees, technical fees, they are all fees for technical services. That is at Article 12A. Can you see?
I can see.
All right.
Thank you.
If you are there, you tell me, and then we move on.
I think we can move on.
All right. Any questions so far?
Yeah, Bill, please, beneath
Yes.
Article 12A, you wrote, is it 44 or it's a reference in bracket beneath Article 12A?
UN, only under the UN model.
Oh, okay. All right. So that's UN.
I said
you.
it's only.
Thank you. I get it. Thank you.
Hello, sir. Please, can you hear me? Hello?
Yes, I can.
Yeah, so
I can hear you.
I was concerned the Article 12A, the fees on technical services. I wanted to confirm why it is captured as passive income. So if management fees is actually part of it, then I believe there is some services being rendered.
I'll come and explain. I haven't taught you yet. This one is just a list, right? So you just exercise patience. Once we get there, you will understand why its nature is passive. It's just like royalties. Fees for technical services in the international jurisdiction are just like royalties. Do you understand?
Okay.
Yes, that is why I capture it as passive. But anyway, if you have a different opinion, you can put it at the active. It doesn't really matter where you put it. I just did this classification just to make things easier for you. Is that okay? So that
Okay.
was the question 3. Is that okay? Shall we proceed?
Yes, please.
Yes.
Okay. So we go to question 4. And the question 4, let's call it special provisions, right? Special provision. So question 4, we'll call it special provisions. So you realize that this one, I'm actually putting it in red again. Very important. It means that every night there's going to be some questions from this area, whether you like it or yes. So special provisions, the first one we'll deal with is under Article 24. So these ones are like for dispute resolution and assistance. Okay, so let's call it mutual assistance in tax matters. What did I say? Mutual assistance in what?
Tax matters.
So this is how Ghana and other countries work together to actually take taxes from other countries or work together to resolve disputes, that kind of thing. Do you get it? That's why we say what mutual assistance in tax matters. And the articles here are actually very interesting and very important, right? So Article 24 deals with non-discrimination for tax purposes. So non-discrimination, right? Discrimination for tax purposes is where two people are treated differently under a tax law. Do you understand? Basically, because that person is a stateless person or that person doesn't have any connection to your country, so you are discriminating against him. So let's say the same transaction was done by a Ghanaian and you tax that Ghanaian at 25%. Then the same transaction was done by a Iranian person in Ghana and you ended up taxing him at 35. This is discrimination for tax purposes. You get it? So Article 24 helps us deal with this discrimination. Then we have Article 25, which deals with mutual agreement procedures, right? So mutual agreement procedures. Okay, so under mutual agreement procedure, now Ghana has introduced the administrative manual, okay, which deals with these things. So these things you have to, do more research. So there's now an administrative manual on maps in Ghana, okay? Very important. You have to have knowledge about it because this means that this is what? Juridical perspective. That means this is Ghanaian perspective. Then the next article, which is very important, is Article 26, which is what we call exchange of information. So how do countries exchange information? Okay, very important. Almost every day you get a question on this. So exchange of information comes with the Common Reporting Standard, or also the Exchange of Information Act in Ghana. Okay, so these are the things you need to look out for. So these three articles, they are the three musketeers, right? But I'll introduce another article, which is Article 27. So Article 27, together with, let's say, Section 98, subsection 4 and 5 of the Revenue Administration Act, help us deal with assistance in the collection of taxes, right? So assistance in the collection of taxes. I think let's make it 3 and 4, yeah. So if, let's say, a UK person comes to Ghana and is owing Her Majesty's Revenue and Customs, or is owing UK some taxes, the Commissioner General on behalf of the UK can take that tax from the tax debtor in Ghana. And some of these provisions, that is what I've written down, can help. So these are all mutual assistance that you have. So as a mutual assistance in tax matters. So every day, expect a question from this side of things. All right. I told you I always break all my courses into. Yes, boss.
Hello, Prof.
Yes, boss. I can hear you.
Please,
I can hear you.
Can you read the Article 26? You said exchange of information plus the other word.
You just write exchange of information. That is all. All of them will go under exchange of information. Okay. All right. So we come to question 5. Okay. So with question 5, let's call it transfer pricing and harmful tax competition, or taxation of international transactions. So when it comes to transfer pricing, we have to look at the overview of transfer pricing, what it is, the types of transactions, all that. We'll come and look at the arm's length principle and its alternatives. Okay. The arm's length principle and its alternatives. Okay. So even after today, I'll send you a full playlist on transfer pricing, like the various topics which are very important, so that you start learning as soon as possible, because every day questions come from transfer pricing. And this is the most failed area. It's like students don't understand transfer pricing. So we look at the overview of transfer pricing. We look at arm's length principle and its alternatives. We come and look at the application of the arm's length principle, right? At the time, the question will require you to mostly do a functional analysis, right? Even in international exams, like when you do audit, this is the most examined area, okay, where you do functional analysis. After that, you come and look at what? Comparability analysis. Comparability analysis, right? Once you understand this, the next thing is to look at transfer pricing methods, right? So there are 5 methods that are allowed. It doesn't mean those are the only methods. There are a lot of methods for transfer pricing, but there are 5 that have been allowed internationally, okay? Some of them, if you apply to the Revenue Authority, they may consider. So there are 5 transfer pricing methods that are allowed, and you have to know them like the back of your hand. I'll give you a trick to know every transfer pricing method like the back of your hand. So we have the cap method, we have the resale price method. Some people call it resale minus. We have what we call the cost plus method. We have what we call the transactional or the profit split method. Okay. So these first 3 methods are called the traditional methods. Okay, these one are traditional because they require a lot of comparability, or there must be some sort of reliable data. And these ones are what the transactional profit methods. Okay. So the 5 transfer pricing methods, you need to know it, in and out, right? So transfer pricing methods comes before comparability analysis, because you need to know this before you can do comparability. So you can swap them, right? Okay. Then from there, we come and look at special transactions. Okay, special transactions. And these special transactions, this is the key weakness of students. Okay. So the key weakness of students are here. So dealing with intra-group transactions, right? So intra-group services, how to deal with intra-group services, the various kinds of intra-group services, things like shareholder services. If it happens in a group, do you actually tax it? Does it meet the arm's length principle? So the arm's length principle is like the most important thing in international tax. Everything is about the arm's length. Does it meet arm's length? If the intra-group services happen, you have to check two things: whether a service has actually happened and whether it's consistent with the arm's length principle. So duplicated services are not intra-group services. Shareholder services are not intra-group services. Okay, so there are a lot of them, and something like centralized services are intra-group services. So any service that a group member will do for himself and be prepared to pay an extra amount for, or a third party will pay for in a similar circumstance, should be considered as intra-group service. But if it is not so, it should not be treated as such. And this is what they bring in question. Then we look at how to deal with intangible assets. So intangible assets or intangible property causes a lot of headache, because this is what multinational companies use to plan. Okay, a lot of tax authorities, intangibles are very complex, even under IAS 38, because we say an intangible is what? An identifiable non-monetary asset, right? Without physical substance. And identifiability under IAS 38 tells us that it must be separable. Can you separate it from the business? Or it must arise out of a contract, must be contractual. Now, these things alone can cause a lot of headache when it comes to tax planning, because our tax laws does not have that identifiability criteria. So I can create an intellectual property right now, right here, and then it will be difficult for GRE to identify that kind of property and the kind of income associated with it. That is why there's a need to understand intangible assets or intangible property in transfer pricing. It comes with issues like unbundling intangibles, because some intangibles are together, and issues around the kind of intangible. It's like what? It can be a trading intangible. Are you getting it? Or it can be a commercial one. Do you get it? So there are a lot of intangibles that you can have, right? The ones that are used in manufacturing and the ones that are used commercially. Are you getting it? Out there, or marketing. Okay, so it depends on the kind of intangibles. And then intangibles mostly focus on the development, exploitation, maintenance, protection, and enhancement of those intangibles. For now, I know some people are thinking I'm just speaking Chinese, but in some few weeks to come, you'll be speaking the Chinese with me too. Amen. All right. So we come and look at another area which people usually find a lot of headache, because hardly does it come in exam, but recently, I think 3 nights ago, it popped up about the types, okay, cost contribution arrangement. Okay, cost contribution arrangements is a difficult concept, even in the practice community. People do not really get it. Let me summarize it for you. Okay, 5 friends, right, want to cook food. A decides to bring saucepan, right? B decides to bring stove. Okay, C decides to bring money and maybe some ingredients, right? And let's say D decides to bring water, okay? And then E decides to bring chairs and tables, or let's say chairs. They don't need tables. Now, assuming the food, we finished cooking the food, who should get more? Who brought something extra?
C.
Who brought something extra?
C.
C brought something extra, right? So C should be paid. And this all this arrangement is about. And this arrangement could be to provide services to someone. I get to know, to develop something for someone. Here is the development CCA. They are cooking food. So it's development. What if they are giving a catering service to somebody? Then it becomes a service CCA. Okay. So they look complex, but if you bring it to our normal terms, they are quite easy. I hope that is fine. So these are special transactions, and then I'll add one, intragroup financing. Okay, this is an area that you have to take very, very important. So intragroup financing. So this is mostly about, interest rates. Okay, so let's say you are giving loan to somebody. The interest rate that you are giving, is it at arm's length or you are manipulating? If Bank of Ghana is giving interest at 20%, and you alone are giving interest to somebody at 50%, are you not biased? Is it reasonable? Is this reasonable? If Bank of Ghana says everybody should charge interest at 20% and you are charging interest at 50%, is it reasonable? Is it at arm's length?
No.
No.
No, it is not, because this is like the basis. This is the basis we use, and you are charging beyond that. So you are not meeting that criteria. Okay, so we'll look at all these rules. Then another area is business restructuring. Okay. Have you gone to the corn mill before? How does the corn mill work? You bring your own corn, right? And then the mill will grind it and give it back to you. And then you pay a fee. True or false?
True.
There could be another arrangement where you own the corn mill and you prepare your own corn. True or false? And sell to other people. But you bring somebody to operate the mill for you. True or false?
True.
So there are two things here. Okay, so we can have a toll system or a commissioner system. So you can convert from a traditional system to any of these systems where the restructuring you are doing, initially you were doing your own thing, but now you are going to just send your stuff to somebody to do it for you for a fee, or you can have all the materials and everything and bring somebody just to do it for a fee. Do you get the idea? So it all depends on the arrangement. That is mostly what will be examined at this level. Right? These things, I try to bring it to the layman's terms for you to understand so that it wouldn't be so complex. Always, people run away from transfer pricing, but I think transfer pricing can be the best thing that ever happened to you because it's the highest paying job out there. I won't lie to you. When we say international tax planning, it's mostly around transfer pricing. And it's only few people who are experts around transfer pricing. So from there, the last area we would focus on is transfer pricing documentation, okay, transfer pricing documentation and risk assessment, okay? And here we'll make a lot of references to the Ghanaian tax law. So we are going to learn transfer pricing documentation, okay? So there are 3-tier documentation. Because of BEPS Action Plan 13, before there were 2, now there are 3. So you need to know all the activities you do all across. You present it in a master file. We have to look at what the activities you do in Ghana, which is presented in a local file. Then we look at what your meeting I had last night. They can confirm. We talked about these things in the morning, and the next day was the paper, and it was there just like that. Fine. Imagine how somebody would have torn the paper. All right. Then we come and look at transfer pricing risk assessment. So anytime you hear risk assessment in transfer pricing, they are just talking about audit. Okay, so how do we carry out the transfer pricing audit? Okay, so we make reference to the Ghana transfer pricing regulations. So all these things they are part of the transfer pricing returns in Ghana. So we will look at that. Then there's something that you must understand. Some people are not supposed to file contemporaneous documentation under our law, and this is something we call the simplified approach. Okay, so if you are doing a transaction which is less than $200,000, you are not really supposed to, file all these returns. There's a simplified approach for you. So when you are going to low value adding intragroup services and technology transfer arrangements, right? These ones follow the simplified approach. Okay, so this is literally what I want you guys to know. Okay, so harmful tax regimes, I will fix it in as and when. So something like if you are doing interest, then we'll learn anti-avoidance provisions like think capitalization. So I can even add think capitalization because think capitalization we can say that it's a topic on its own in your syllabus, right? But however, it's part of what the anti-avoidance provision. So think capitalization, we'll know it internationally, and then we'll come and look at what's the fixed ratio approach. That is section 33 of Act 896. And we are going to look at the arm's length approach. That is section 31 of Act 896. Okay, mostly we can refer to controlled foreign corporation rules or income splitting under section 32 of the Income Tax Act. Okay, so we'll come and understand all these these things. And this is a complete, I mean complete overview of the international taxation syllabus. So you see all the things that you've seen here, it is what I've broken down into these areas for you. I hope that is okay. All right. Any question before we proceed to the next session? Any
Hello,
question
sir.
before we... Yes.
Please, which article deals with was it literature or something like that? Hello.
Please, can you come again? I think we didn't hear you.
Yeah.
Yes, please.
Yeah, please. I'm
Is that
asking
equal?
which article deals with
Yeah, can you...
professors or teachers. You said you give us some article.
No, I gave you the article. I gave you article 20. We have some articles that directly do not have any home. Right?
Okay,
So
okay. Okay. Okay.
Hello, sir.
All right, I'm back again. Yeah, any questions before we proceed? Oh, that's fine. Can you hear me when I speak?
Hello, sir.
Yes, sir. Yes,
I hear you.
I
I can hear you.
can hear you.
Hello.
Time for questions. Very important.
Hello, sir. Hello.
Yeah, I can hear you.
Okay. All right, sir. Please, can you come again with the difference between the financial service, intergroup financial service, and then intergroup service?
We will come there.
Okay, sir. All right. Thank you.
So, international taxation. What is international tax? We have already talked about international tax in brief, and we said it's really how our tax laws interact with each other, right? So the global tax rules that apply to transactions between two or more countries, which we call states in the world, is what we call international tax. And it encompasses all the tax issues that arise under a country's income tax laws that include some foreign elements. So remember I told you that the tax issues that arise under a country's income tax laws that cover some foreign taxes is what we call international tax. So taxes are actually not international, and there's no separate global tax law that governs cross-border transactions, that this is the law that treats all cross-border transactions. It's not there like that. So there's no international tax court or any administrative body for international tax issues. All taxes are levied All taxes are levied under a domestic law. So even if we say international tax, remember, if Kofi goes to the UK, right, to trade, is the UK tax law that will tax him, true or false? But Kofi is a Ghanaian. That means when he brings his income, the Ghana tax law will also tax him, true or false? So the international tax we are talking about is still the taxation under the domestic law of one or more countries. Do you get it? So simply, that is it. So since we are saying that, yes, we are looking at the part of our law that has a foreign touch. When we come to Ghana, there are different parts of our law that has a foreign tax, right? But this is the trick to passing international tax. Anytime there's international tax, it means that the exam question will be examined from two broad dimensions. Okay? Or not even in exam alone, even in practice. If you are dealing with international tax issues, it's from two broad dimensions. Either you are taxing Ghanaians or resident individuals and corporations on income that arises in a foreign country. Like the example I gave with Kofi, right? You all get the idea. Kofi is a Ghanaian, but Kofi went to the UK and was taxed there. So Kofi is a resident of Ghana, but he's taxed on foreign income. So if any question will be given to you, it's either a resident person is taxed on foreign income, that is one, the first perspective of international tax, or the first dimension of international tax, taxing residents on foreign income. So you see there's still interaction of two different laws. A Ghanaian person, Ghana tax law, and his income arising in a foreign country, foreign tax law, right? Then there's the taxation of non-residents on income arising domestically. So this is where we have Kenichi. Kenichi is a Japanese who has come to Ghana to establish a sushi restaurant. So you see, Japan law interacting with Ghana law. You get the idea, because when he goes to Japan, he's resident in Japan, but he came to make money in Ghana. So this is what rules will tax Kenichi when he's in Ghana. So these two broad dimensions, I would rather you write them down, because it is very, very important. If you can do this, I mean, you should be fine when it comes to international taxation. So if you have any question, I told you, you can put it in the chat section, because then everyone is muted so that it wouldn't bring disturbances and distractions. After that, I'll give you, after each session, you have the chance to ask all the necessary questions. All right. So have you written the two broad dimensions down? You can just give me a thumbs up and then I'll know. It's very important. Okay, so we are either taxing a resident person on foreign income, or we are taxing a non-resident person on domestic income. I hope that makes sense. All right, so that is it. So since we said that, well, we are looking at the part of our law that has a foreign element. So in actual sense, international tax encompasses all tax issues that arise under a country's income tax laws that include some sort of what? Foreign element. So the part of the Ghanaian tax law that has a bit of foreign element can be seen or can be said as international taxation. Do you understand international tax? All right. So let's look at the part of the Ghana tax law that deals with international tax. So there are a lot of them. So section 3 is what connotes worldwide income. We'll come and look at it. Okay. We look at exempt amounts, section 7. We look at section 31 dealing with arm's length arrangement between associates, the arm's length principle, income splitting, controlled foreign corporation rules. This section, you can also call it base erosion and profit shifting. Income splitting is base erosion and profit shifting. You are eroding your tax base and shifting profits to another place. Maybe the place has a higher tax rate or lower tax rate. It depends on the ability to, massage your profits. That's what multinationals do, right? So at your level, you're a senior financial executive and you'll be dealing mostly with multinationals and their assumptions and all that. Then we look at thing capitalization, which I mentioned earlier. Section 33 deals with it. We look at section 34, that has what? General anti-avoidance rules. Then we look at the issue of residents, resident individuals, resident partnership, resident trust, resident companies. We look at changes in residence and realization. So this as if I leave Ghana today and I'm no longer resident, what happens to my assets that are in Ghana? Do you get the idea? Assuming I change residence today. So we look at sources of income and quarantining of foreign tax losses by resident. We look at sources of amounts directly included and directly deducted from profits in Ghana. So these are like sources of income for a resident person. Then payments that are sourced from Ghana. We come and look at the interpretation of residence and source. So these are all parts of the Ghanaian tax law, principles of permanent establishment, activities, assets and liabilities of a PE, income or loss of a PE, interpretation of a PE. So a PE in Ghana under interpretation can be a foreign PE or it can be what? A Ghanaian PE. So the whole thing is that a PE says permanent establishment. A PE is simply a business of a non-resident person in another country. So if I'm in Ghana and someone else has a business in Ghana from another country and he's not resident, then that is a permanent establishment. He has established himself permanently in our country and he is doing business. If he has a fixed place available to him and it's at its disposal, then it constitutes a PE. And we must learn rules around this. People were taking advantage of it. So the New Companies Act called this external companies because a PE is not registered. Before, a PE is not registered, but just a mere extension of the original entity that is in another country. So if I sell shoes in the UK and I come and open a branch in Ghana, or I use an agent to sell those shoes in Ghana, it still constitutes a permanent establishment. And you must learn all the rules about PE to become so good with international tax. Okay, section 112 talks about relief from foreign credit, methods and time of payment, and then the regulations. These regulations have been repealed, right? Section 127 has been repealed by the Exchange of Information Act. Okay, so we will get there. Then section 98, we talk about international arrangements, that is DTAs. They have been ratified by the Constitution, the 1992 Constitution, there are some rules. Then we look at what tax avoidance arrangements, and this is where people try to get tax benefits under the law. This is also a general anti-avoidance provision, but mostly we use this to deal with things around treaty shopping and treaty abuse, right? So basically, these are the parts of our law that deal with international tax. Okay, there are other ones too, but these are the most important ones, all right? So that was an introduction to international taxation. So let's look at how international tax interacts with our domestic tax systems. Now, the starting point for any study of international taxation is a broad knowledge and understanding of the domestic tax rules in different countries. I told you before that there's no international taxation like this is how we deal with things internationally. It's just you being taxed under different rules, under different countries' laws, right? So the domestic tax law governs the tax rate, what is taxable, how the taxable income is computed, and the tax compliance rules. Don't forget, that if you talk about tax, apart from the planning, there is compliance. All right. So me filing returns, assuming I even pay tax in UK, am I supposed to file returns in Ghana? What are the application processes? These are compliance rules, right? So it is essential to know the tax rules and how these rules are applied to cross-border transactions in a given country. Now, under the domestic tax laws, a tax liability arises in a country only if there's a connection between the tax jurisdiction and either the taxpayer, who we call the tax subject, or the taxable event, which we call the tax object. So the whole thing is that a tax liability can be created in a country if there's a connection, which I told you we call one nexus. So if there's a nexus between what? That jurisdiction and either the taxpayer or the transaction, the tax object is the transaction that has happened, then we can say there's a connection. And this is the problem that digital economy causes, right? Now, somebody is making a lot of money from YouTube. Okay, how does GRA tax it? What is the connection between YouTube and Ghana? Though, yes, the person is in Ghana, but the source of his income, is it connected to Ghana? Are you getting? What about somebody who is doing online betting in Ghana, but he's in Nigeria? So you see, in tax, you have to actually establish a nexus or establish a connection between the country, okay, which is the tax jurisdiction, and the taxpayer, and that transaction happening. Okay, and this is what is causing all this brouhaha on the internet, bringing equalization levies and people meeting G20 and all those meetings. It's just because of this. And this is a big problem. So multinationals have identified these loopholes and they are using to take advantage of tax authorities. Do you understand? So if you want to check all these things, right, these factors or this nexus, you need to establish the residence of the taxpayer, where his income is coming from, the place where the income is earned or derived, and the location of a taxable asset. Okay, so these are rules that we use to check connections we have between jurisdictions. Are we okay? So that is it. So all these things that we are saying may cause a lot of problems, right? And we will come and look at it very well. Now, we all know that countries enter into double taxation agreements or double tax treaties. Okay, and one thing you must understand is that double tax treaties generally will override the domestic law. Okay, so they are internationally binding obligations between sovereign states and not the taxpayer. So initially we talked about what? Tax sovereignty, and I told you that this is the power of states to actually what? Make their laws, administer those laws, and what? Ask people to pay money. And this tax sovereignty is what has caused all this double taxation, because Nigeria has what? Its power to make its own laws, administer them, and collect money. Ghana also has its power to make laws, administer, and collect money. When these two clash, because this is Kofi, if Kofi goes to Nigeria, Nigeria can take money from Kofi if he does activity there. And because Kofi is resident, Ghana will also take money from Kofi. When this happens, it creates double taxation. So there's a need for Nigeria and Ghana to enter into a treaty. It's not really necessary, but if they must sort of what? Find ways and means to reduce the tax that Kofi will pay. Is that okay? So there's one thing you must understand, okay? That DTAs generally override the domestic law. So though your law is the supreme law of the land, when you enter into a DTA, it means that two sovereign states finally agreed that this provision should be done for its members. So assuming the Ghanaian tax law says otherwise, the DTA shall prevail over the Ghanaian tax law. And this rule is a secret to passing international tax, okay? So far as Ghana is involved, this is a secret to passing international tax. If you are solving a question and you see that, okay, they've given you something, let me give you a typical scenario. In our Ghanaian tax law, when you, let's say that, when you have a PE, okay, for construction activities in Ghana, when you do it for 90 days or more, it creates a PE. Let's say that in the Germany, Ghana DTA, if you continue for 9 months, right, then it creates a PE, 9 months or more. So this 90 days is like 3 months, right? And this is 9 months. So if a German company comes to Ghana and that German company comes to, let's say, do a construction activity for the, let's say, if he does it for what, 7 months, you are going to say in the question that, okay, the position of the domestic law is that this guy has done construction for what, 7 months, which is more than 90 days. So it creates a PE. But however, in the Ghana, Germany DTA, it says that this activity should go on for 9 months before it becomes a PE, right? So there's a conflict between what the Ghana tax law and then the German, the DTA between Germany and Ghana. But which one will take precedence? The DTA shall take precedence, right? So when you are answering questions, learn to be chipping in this. If you chip it in, you get extra marks because you're actually telling them, yes, how it should be done. So section 98, one of the Revenue Administration Act, is what we mostly make reference to, okay? So it states that to the extent that the terms of an international arrangement, which is a DTA, to which Ghana is a party, are inconsistent with the provisions of the tax law, the terms of the international arrangement shall prevail over the provisions of the tax law. So where there's a conflict between the provisions in the DTA and our Ghanaian tax law, the DTA would take precedence. So it means that this is the secret. Okay, I've given you a lot of keys. If you have really been listening to me, you don't have any problem with passing international taxation, even when you are doing audit, right? So the whole thing is that this is the whole thing. It was created by sovereign states, and as such, it has more power than the normal law. Because Ghana didn't look at its differences, maybe Italy didn't look at it, and they came together, formed an agreement to help relieve taxes of their people. So it should have a lot of power, right? But there are several instances where the domestic law may have power over the DTA, and we call that a treaty override. Okay, so there are several circumstances. We'll come and look at that later on, but for now, I don't think these things are important. Okay, so one thing I want us to talk about is the sources of international taxation. So we said there's no international tax codes, there's no international rule that governs international tax. So where do we get international tax from? International tax can come from what? Several sources. It can come from primary sources, which are the laws themselves, right? That bring international tax law. There's something we call the Vienna Convention on the Law of Treaties. And this one talks about how to deal with treaties, like their interpretation, what they mean, how to deal with treaties, all that. It's not only for tax treaties, but any kind of treaty, we can find the principles, like a treaty shall be interpreted in good faith, right? Okay, so we can look at those rules, like for interpreting treaties. So we have to look at this when we get to treaty interpretation. Then we look at model tax conventions. As I told you earlier, these model tax conventions are like frameworks that we use to form double taxation agreements, right? So it's like a reference document. And I told you we have the OECD model, which is the oldest one. Then from there came the UN model. Then finally we have the US model. By your exam, until we have a DTA with US, we don't use the US model in Ghana. But if we have a DTA with US, then a lot of students will fail because there are a lot of, if you read the US model, there are slight variations which make it quite complex than these two. All right. Then we have customary international law. Okay. The tax treaties themselves are primary sources. So you can get information from other tax treaties to create new tax treaties. I hope that is okay. Then there's customary international law. There are some things that have been customarily written internationally, but becomes law by practice over time. So we can make reference to something we call judicial principles, right? Or we can call them judicial anti-avoidance rules. So these are examples of customary international rules, like something like substance over form. We are saying what? The substance of a transaction over its legal form. We can use a technique like business purpose doctrine, right? Somebody doing something, is it only for tax or he's actually doing it for business purpose? Let me give you a typical example. When we visit section 59, subsection 3 of Act 896, right? There's a rule there. And that rule says, okay, if I'm doing international tax, that's what we call a participating exemption. So far as two resident companies, right? Resident company A acquires another company, resident company B, whether directly or indirectly, and owns at least 25% of the shares in this company, right? If B pays dividends to A, those dividends are going to be exempt from tax. Do you get the idea? So let's look at something here. If this is going to be exempted from tax, then if there's a US company here who is hungry for this exemption to get a lot of money without paying tax, this company can intentionally come and buy shares in company A, right? Let's say I own 100% of company A, and company A can go and buy shares in company B, right? So if you buy the shares in company B, then you know that this guy will be exempted from tax. But who is the actual beneficial owner? Who is enjoying the benefit? It's the US company, but he's hiding in the shadows. So we can make a reference to something like the business purpose. Was this transaction, the tax authorities can look at it as, okay, was this transaction done purposely because you want to do business and invest, or you did it just to enjoy this tax benefit? If the tax authorities deduce that you did it just so you can enjoy the tax benefit, they may disregard or recharacterize the transaction and cancel any transaction between this guy and deal directly with the US company. Okay, so there are many provisions in our law to deal with something like this. You can make reference to Section 27, indirect payments. And indirect payment is simply saying that when the commissioner sees that what somebody who is supposed to be the actual payee of a transaction has directed someone else to be the payee. So in this case, we are saying that the US company is the actual payee, the one who is supposed to receive the dividend, but he has instructed A to be the payee. When the commissioner sees this, he may disregard this payee and deal directly between the US company and B, which means that that dividend wouldn't be exempt again and would actually be taxed using the rules. Okay, so these are some little things that will come across as we go around. Okay, so another principle is general principles of law. The rules of law still apply in international taxation. Then the secondary concept or the secondary sources of international tax are just the ones which, are gotten from the primary sources. So textbooks, like my textbooks, practice notes and guides, online research, tax document rulings, dictionaries, journals, news, online blog posts, videos, all these things are secondary sources. Okay, so when we talk about the sources of international tax, these are the concepts that you need to understand. So we will come and talk about the concept of tax equity and tax neutrality later when we get to reliefs, but for now, let's ignore it. So as I told you, there are some things that are causing brouhaha in international taxation. Before you can do international tax as a student, you must understand these things. Okay, so policy issues or policy objectives in international taxation is to eradicate what? Double taxation and reduce tax competition. Those are the policy objectives. So there are two main policy issues in international tax. When we say policy issues, we are just talking about the things that are causing headache in international taxation. And there are two main. One is double taxation and two is tax competition. Okay. And all these things are caused by that thing I told you, tax sovereignty. Nigeria being able to create its own laws, administer and take money. Ghana being able to do the same. South Africa being able to do the same is what is causing all these problems. I hope that is okay. So tax sovereignty is just the power of jurisdiction of a state to tax, and it is the independence and autonomy of the state to impose and collect taxes. And there are three types of tax sovereignty. Legal sovereignty, the ability to make your own laws. Administrative sovereignty, the right of the tax authorities to administer and enforce the tax laws. And then revenue sovereignty, which is your ability to collect all tax revenues. All right. So I said, so far as all of us have the ability to take money, definitely there'll be a problem. And that is the problem of either tax competition or double taxation. All right. So we saw the policy issues, and one thing you must understand that is causing all this headache is the concept of residence and the concept of source. All right. So let me just explain this to you to understand. Okay. So in this principle, the principle of residence or the residence principle, the country taxes the individual or entity based on his residential status. So if you're a Ghanaian, they tax you because you are a Ghanaian or you are a resident of Ghana, right? So that is the concept of residence. So the residence status of individual is different from citizenships. Sometimes they are the same. I don't want to bring confusion in the minds of people, but there's a difference between residence and citizenship. However, you can be a resident and not be a citizen, and you can be a citizen. Okay, citizens may be residents, but residents may not be citizens. Let's understand it like that for now. Now, every country's tax law provides the basis on which the individual could be classified as residential to that country for that year. So one thing I want to put across to all students or all practitioners is that resident is determined every year. So it means that I can be resident in Ghana in 2024, but maybe I wasn't resident in 2023. I won't be resident in 2025. It's all depending on the rules, right? Okay, so this is very important. When you are solving questions, learn to bring these policy objectives, right? They are like tax policies, and they enrich your answers. I will teach you how to deal with international tax questions, how to answer it to the satisfaction of the examiner. A lot of students have the knowledge, but they cannot apply. Okay, and anytime you are dealing with scenario questions, I think yesterday I told you there are three main types of questions that we should expect in every exam that has cases. Answer in the scenario type of questions. What do you think type of questions? And finally, theory or knowledge requirements, right? So these are the ways you do it. And if you are very good with the techniques I'm going to teach you, no matter the case you get, you'll be able to express yourself because you know everything can be learned, right? There's no genius anywhere. You can be your own genius. You can learn it actually. Skills are learned. That is the thing. So I told you resident is tested every single year. And that is the rule. So in the case of income tax, where the person is regarded as a resident for tax purposes, the country may tax the income of that person regardless of where the income has the sources. So this connotes what? Worldwide income. And this thing you really have to understand it. So far as you are a resident of Ghana, we are taxing all your income, irrespective of where the income came from. Okay, so if I make money in Senegal and I was taxed in Senegal, if I make money in Morocco, I was taxed in Morocco. If I make money in UK, I was taxed in UK. If I bring it to Ghana, Ghana still has the right to tax it because I'm a resident of Ghana. You get the whole thing. Ghana has what? The right to tax the income because what? I'm a resident of what? Of Ghana. So that is one thing you must what? Understand. Okay. Now, most countries tax their residents on worldwide income, and that is what I told you. Ghana. So if you're a Ghanaian, no matter where you earn income, whether you have paid taxes on it already, we don't care. We must still tax all that income in Ghana. You must disclose all your full income, your worldwide income, your full tax liability will be derived, right? So some countries only tax residents on incomes that are derived from sources in those countries, like Panama and Costa Rica. So they use purely the source principle. So in actual sense, the residence principle is taxing people on their worldwide income, and the source principle is taxing people only on income that has a source in those countries. Are we okay? So that is a rule you must understand. And these are the connecting issues that may cause double taxation. All right. So the concept of source. Tax is also imposed by many countries if it is considered to have its source therein, regardless whether that income is derived by a resident or non-resident. Similarly, capital taxes are levied concerning property situated in a country, regardless of the residence of the owner of that property. So if I have building in Ghana and I get rent, it will be taxed in Ghana because the building is situated in Ghana. So the whole thing is that when it comes to source, sometimes this is known as territorial system of taxation, right? So we tax income based on our territory. So in that case, if an Indian comes to Ghana to work and he works as a chef in an Indian restaurant and he gets paid 20,000 Ghana cedis, right? This 20,000 was actually derived from Ghana, meaning it has a source in Ghana and as such shall be taxed in Ghana. Do you get it? So the whole thing is that the source rule says looking at where the income was derived in the source state. So source is the income will be taxed at source. It will be taxed in that country. And residence is what? The income will be taxed worldwide. Now, these two things cause double taxation. And let me explain. Okay? Let me explain. So let's look at Kofi, right? Our good friend Kofi. So this is Kofi. Okay, now Kofi, we know Kofi is a Ghanaian, so he should be taxed on worldwide income. Is that not what we learned? So Kofi will be taxed on worldwide income. So in the context of Ghana, all Kofi's income, okay, income that he receives from a foreign country, so income received from a foreign country, okay, which will be received in Ghana from a foreign country. So income received in Ghana. So there are 4 categories of income. Income received in Ghana, income brought into Ghana, okay, meaning he derived it maybe in the UK and he's bringing it into Ghana. So Kofi has two options for foreign income, okay, foreign source income. It means that maybe Kofi is in Ghana, he did some investment in UK and they remitted it to him in Ghana. So that's income received in Ghana from another country. Then income brought into Ghana. It means that Kofi brought that income to Ghana, right? Okay, these incomes have a foreign source. Then we have income what? Derived in Ghana and income accrued in Ghana. So look at this. All this income is the worldwide income of Kofi, right? Because Kofi is a resident of Ghana, we don't care whether you pay tax on this income you brought or received in Ghana, we'll still tax you, okay? So assuming Kofi is taxed on all this income. Now, when we go to UK, Kofi would have made money in the UK, right? And that's the money he would have received in Ghana or brought into Ghana. But because in the UK, Kofi's income was at source, okay? Kofi's income was at source. So that income that Kofi received in Ghana and brought into Ghana, UK would have taxed Kofi because the income was derived at source. And Ghana too would tax him on his worldwide income. So Kofi has paid tax twice. Have you all understood? And because Kofi has paid tax twice, it creates double taxation. Do you get it? So two countries have taxed Kofi on the same income. Let's see. So this is Kofi. Let's look at the UK perspective. So in the UK, Kofi generated £100,000, right? So that's his income, his business income he generated from the UK. Now, assuming he paid tax at 20%, right? So he would have paid tax of £20,000, right? So that means Kofi gets a net income or a net remittance of what? 80,000. Nice. Now, Kofi getting this net remittance of 80,000, he now comes to Ghana, right? Because he's a resident, we take the whole gross income. So in Ghana, he will bring all his worldwide income. That is what he earned in Ghana and those foreign countries. And this whole 100,000 is what he'll bring, not 80. He will disclose the whole 100,000. There's a reason why you should do so. So now Ghana will tax this whole income at 25%. So in Ghana, you end up paying 25,000 on the same 100,000, right? So at the end of the day, the total tax liability of Kofi is what? 20,000 he paid in the UK, and then what? 25,000 he paid in Ghana, right? So that means overall, Kofi ended up paying 45,000 total taxes, which is very bad. Nobody will want to go to a country and trade and pay tax and come back home and pay tax. That's why a lot of Ghanaians are running away. They don't want to, and some of them will hide their transactions without appropriately disclosing them. Okay. And this is the reason, because of double taxation. So there's a mechanism to stop these things from happening. Okay. This source and residence principle are the causes of double tax. They cause double taxation. Have you seen? So it's because one country is saying that you are resident and another country is saying that what? Oh, your income arises at source. Because of that, it is creating what? A problem. That one country will tax you because the income came from there. One country is saying that, okay, you are also taxed here as a resident, right? So if a resident system and source system clashes, it creates double taxation. Have this in mind. So if you're solving questions, learn to be chipping some of these things in. Okay, so that was it. Now, let's understand the concept of double taxation. So what is double taxation? Double taxation is where someone is taxed twice, okay, or where comparable taxes are levied on the same income or the same person, right? So we can say where comparable taxes are levied on the same person or same income twice or multiple times. It doesn't really matter. It's still double taxation. Either by two different jurisdictions or two same income in the hands of two separate taxpayers. So what do I mean by that? So with Kofi's case, we saw UK taxing Kofi and Ghana taxing Kofi. That is what we call juridical double taxation. Juridical double taxation. Why juridical double taxation? Juridical double taxation because it is two different tax jurisdictions that are taxing him. Do you get it? So juridical double taxation is where two different countries are taxing the same person. Why? Because of a lot of reasons. I'll come and talk about it. Now, the same way, the same income can be taxed in two different countries or same country, but in the hands of two separate taxpayers. A typical example. Let's take ABC company, right? So what happens? ABC company generates profit before tax of 100,000. Okay, or let's say 100 million. Okay, 100 million. But you see this profit before tax, we will tax it at what? Let's say in Ghana, we'll tax this at 25%, right? This same profit, we take 25,000 out of it, and then we end up with what? We end up with 75,000. This is still the same corporate profit, right? But this is the net profit after tax, right? Okay. Now this net profit after tax, if we are distributing this as dividend to the shareholders, right? Assuming this whole profit is given as dividend, or even a part of it, you see that from the shareholders' perspective, they will receive dividends, right? So let's say shareholders receive a dividend of, let's say 50,000 and the rest was reinvested. Is this still not a portion of this profit that is given to shareholders? But you realize that this will be taxed at 8%. Okay, so this will be taxed at 8%, which is around 4,000, right? So you see that this same corporate profit was taxed at the corporate level, was taxed at the corporate level and was also taxed at the individual level in the hands of a shareholder. So this is what we call economic double taxation. Okay, so in your syllabus, mostly the things you'll be learning will be to deal with juridical double taxation rather than economic double taxation. Okay, so economic double taxation, yes, you have some rules dealing with them, like anti-avoidance provisions and whatnot, right? Or taxation of things in the domestic tax law and stuff like that. But mostly our focus, exam is mostly focused on juridical double taxation. So I told you in simple terms, there are two types of double taxation, two forms. One is what? Juridical, and I hope I gave you good examples to understand. So juridical is when one person is taxed twice by two different states, and then what? Economic is when one income is taxed twice in the hands of two separate taxpayers or two separate people. And we know that the causes of these things comes with what? Two connecting factors, right? And we talked about them, the principle of residence and source. All right, so we are going to look at the causes of double taxation. The causes of double taxation. So what are the causes of double taxation? So we have the connecting factors, right? And these connecting factors lead to the causes. So what are these connecting factors? We said the connecting factors were the principle of residence. That's the residence what? Principle, which says what? All residents are taxed on worldwide income, right? All residents are taxed on worldwide income. So if we come to Ghana, we can make reference to section 3 of the Act 896, all right? Then we come to the source principle, and the source principle says what? All income that has a source in Ghana, or let me use all non-residents, are taxed on source income. So any income that has a source in that country must be taxed, not all non-resident, everyone. So far as you have income in a particular country that has a source, it must be taxed there. So in Ghana, we also make reference to section 3, subsection 2B, right? So that means this is a very important section. That is why I wrote it down. So we can make reference to the Income Tax Act. Let's see. When I have the Income Tax Act here, and then we will read for you to understand why this is a very important section. Section 3 as amended. Let's read section 3, assessable income. So I believe you can all see my screen. Yeah. So the assessable income of a person for each year of assessment is the income of that person from any business, employment, or investment. The assessable income of a person for a year of assessment from any employment, business, or investment is 1. In the case of a resident person, the income of that person from each employment, business, or investment for the year, whether or not the source from which that income is derived has ceased. So if you are a resident, they didn't mention where the income came from. So it connotes worldwide income. So we are telling you that so far as you are a resident and you make income from any employment, business, or investment, whether or not where you got the money is no more, but it was derived during the year, it will be taxed. So it didn't tell you where the money was to be generated, meaning so far as you're a Ghanaian, anywhere, or you're a resident person in Ghana, anywhere you generate your income, whether or not the source has ceased, will be taxed in Ghana. And in the case of a non-resident person, let's see. So you see what we saw up there was what? Was the residence principle. So you see we are taxing you on what? Your total income. So here we are taxing you on your total or your worldwide income, right? And these are the basics for international tax, which people ignore. Then if you're a non-resident person, look at what it says. In the case of a non-resident person, the income of that person from the employment, business, or investment for the year, to the extent to which that income has a source in this country. Okay, so far as you have a source, you see the source principle shining its teeth at you. Yes, this is the source principle. So we are saying that, okay, so at the end of the day, so far as that income has a source in Ghana, it must be taxed as such in Ghana. Makes sense. Now, where a non-resident person has a business in Ghana, I'm not saying, I haven't taught you PE, so just when a non-resident person has a business in Ghana, income for the year that is connected with that business, irrespective of the source of the income. So you see, everything must be connected to Ghana. So you see, residents are taxed on worldwide income, non-residents are taxed on source. So what if one country you are taxed at source and one you are taxed at resident level? It creates a conflict. And when these conflicts happen, it leads to double taxation. So now that you understand the source and resident principles very well, so the source principle can also be known as territorial principle of taxation, because you are taxing whatever is in your territory. So territorial taxation or source taxation. So let's look at the causes of double taxation. And you know, the causes are actually these two that lead to the causes, right? So the causes of double taxation. So these causes of double taxation, the first cause is what? A residence source conflict. Okay, so you know that when these conflicts happen between the residence and source principles, it causes what? Double taxation. So when the residence system and the source system conflicts, like the example of Kofi that we use. So when there's an overlap between a residence system and a source system, right? Then it creates a residence source conflict. And this is the common type, like the issue of Kofi. He made money from UK source, then he came to bring that money to Ghana again, right? Which is his resident country. So Ghana is taxing you based on resident, UK is taxing you based on source. So it leads to a conflict, causing a resident source juridical double taxation, right? Then the second type is what? A source conflict, source to source conflict. Now, this type of conflict happens when there's been overlap between two source systems. So one country is saying that the income was generated in my country, let's say Ghana. Nigeria is also saying that the income was also generated in my country, Nigeria. So at the end of the day, what happens? There's a conflict. Let me give you a typical example. If Manuel was employed in Ghana, right? He was employed in Ghana, but he was stationed to work in Nigeria. If the money is being paid, it depends on the nature of the person's law. Maybe Nigeria's law says that so far as the person has physical presence there, he should pay tax. A Ghanaian tax law is saying so far as you were employed in Ghana, you should pay tax in Ghana. So at the end of the day, all of them are saying that the income has a source in either Ghana or Nigeria. So both of them are saying that the income has a source in my country. So this leads to a source-to-source conflict, right? Because he's working in Ghana, was stationed in Nigeria, he has physical presence in Nigeria. So Nigeria wants their fair share of the tax revenue. Makes sense because of tax sovereignty, right? So 3, we have what we call residence conflict, right? Now, residence-resident conflict is where there's an overlap between two residence systems, okay? Now, this is where two countries are saying that, oh, this guy is resident in my country. So you are resident in 2 countries. This creates an issue of dual residence. And we'll come and deal with dual residence in Article 4, right? So this creates an issue of dual residence. Now, with the issue of dual residence, we usually use something we call the tiebreaker rule to deal with it. So when we get to Article 4, paragraph 2 and 3, we'll learn the tiebreaker rule. So let me explain. Let's say this is Selom, right? Selom, this is a typical question. He's a footballer. He lives in, let's say, UK with his family. And the same way, Selom is a Ghanaian by birth. You get the idea? So literally, it is telling us that this guy is resident in UK, resident in Ghana. He's a dual resident. So UK will tax Selom on worldwide income. Ghana will also tax Selom on worldwide income. That's not fair, right? So anytime such issue happens, the tax authorities will decide which country gets the taxing right of Selom. So they have to do some test. And this test is what we call the tiebreaker rule, okay? So first of all, the tax authorities must establish which country Selom has his permanent home, okay? Where do you have your permanent home? Do you have a place available to you at all times and continuously? That's your permanent home. If we cannot find your permanent home, that means you either have permanent home in both states or neither. We have to look at your center of vital interest. Where does your economic and family relations exist, right? Where your economic and family ties or your personal ties are closer. We call that your center of vital interest. We look at that, right? We look at your center of vital interest. When we cannot find your center of vital interest, the next thing we have to do is to go forward to look at what? Your place of habitual abode. So we cannot see where your family is. So where do you stay often? If you cannot determine where you stay often, the next thing is to what? Check where you are a national or you're a citizen. If we cannot determine that, then the tax authorities must settle by mutual agreement procedure. So this is a tiebreaker test for individuals, right? But for companies, assuming 2 companies, let's say a company is incorporated in Ghana, but it has its management and control in the UK, or it is listed on UK Stock Exchange, then that means it is resident in 2 states. So the tiebreaker test, which we are going to use for companies, is now on a case-by-case basis. From 2017, it is on a case-by-case basis, considering all the circumstances, right? Under a mutual agreement procedure. So now it means that we test 3 things. First of all, we test the place of incorporation. 2, we test the place of effective management. And then 3, we look at other factors, okay? Other relevant factors like where the company was resident, where its head office is located, where its management staff are located, where its headquarters are, where the accounting books are kept, where commercial decisions are taken, right? But before 2017, if a company was resident in 2 or more countries, we use what? The place of effective management as the sole test for determining what? The tiebreaker rule for companies to know which country we should be taxing you or which country you are resident. Now, in Ghana's double taxation agreement, because most of them have not been modified, we still use the place of effective management. So it means in exam, whether you go by the case-by-case approach and talk about all these 3, or you go with the place of effective management, which still encompasses these issues, you will still be marked correct, right? So it doesn't really matter. So these were the causes of double taxation. We have seen double taxation, the connecting factors, the causes, right? So that was double taxation. So we know double taxation causes untold hardship. What are the disadvantages of double taxation? It discourages investment. It leads to tax evasion and avoidance, right? And people will not be encouraged. Okay, and it actually declines people's notion about a country. Okay, so these ones you don't have to read any book. You can think about it. Why would it be disadvantageous to you if you are taxed twice? All right. Okay, so that was another session, and then it's time for Q&A before we stop that session. So I will unmute, and then you ask your questions. You can unmute and ask your questions before we proceed to the next session. I bombarded you with so much information. That is true. So it's time for questions. Yes, boss. My bosses. Please, so we have less time, so ask your questions and let's proceed.
Okay, Prof, please can you hear me?
Yes.
Hello?
Yes, please.
Yeah, so with a tiebreaker for the individual, in this case, which one of them is like superior? So in cases where it cuts across, let's say the permanent home and the center of vital interest is with one location and then the other with the other. So which one holds?
It depends on which one. The test is in steps, so it's not all. It means that we do step 1. If we can't find it, then we go to step 2. If we can't find, then we go to step 3. So wherever you end, if that thing is sure for one state, then that becomes it. Otherwise, if all these steps become inconclusive, then the tax authorities will now have to settle on mutual agreement. So no one step is important than the other, but it's a series of steps. It's a step. It's steps. Is your question answered? Means that if we cannot find your permanent home, we will now go and test your center of vital interest. If we cannot find that, we look at your habitual abode. If we cannot find that, we look at where you are national. We cannot find that, then the tax authorities will settle. But with a company, if we cannot find all this, then you lose all the benefits. That's the rule. That's the only thing with companies or entities. Okay, so if you cannot find where you have your if the tax authorities cannot settle by mutual agreement, then you lose all the benefits. So that's the whole thing. All right. Is that the only question or there's another question? Please, let's take your questions, at least 3 questions, and then we move. Quick. If you have no question, we move to the next level, which will involve some calculations, very detailed area. Yes? Any question?
Yeah.
Okay.
Yes. So in determining the residency, if we have a citizen or a Ghanaian who has a permanent home outside Ghana and stays there for the whole of the year, do we say that as far as the person is a citizen or a Ghanaian, he's still a resident in that year of assessment?
Unless you stay outside for a whole year. That's our rule in our law. So if you stay in another country for 364 days and come to stay in Ghana for 1 day, you are still resident in Ghana. When we get to residence, I'll talk about it in detail. So Ghanaians, so far as you stay in Ghana, we see your face in Ghana, even if it's 1 hour, you haven't stayed 365 days in the other country, you are still resident here. So it can lead to a lot of problems. Is your question answered?
Yes, please. Thank you.
Last question, then we move on to the next session. Last question. Hey, I have sharks. So I bombarded you with information and there's no question. Yeah, Emmanuel.
Hello, sir.
Hello, sir. Oh, who has a question for me?
Yeah, it's not a question, but at some
Yes,
point I found. Hello, sir. This is Emmanuel.
Yes, sir. I can hear you.
Please, can you hear me?
Yes, please.
Yeah, I was saying that at some point I was struggling to follow because the speed was I don't know whether it's my end alone.
Yes, it's because the video will be available to you to watch and rewatch, pause, rewind, and do everything, right? So
Okay, sure.
you watch. And this will also push you to learn. Because when I slow down, you have all the information at your disposal.
Okay, sure. And also
And
the articles.
Yeah.
The articles, are you supposed to memorize them?
Yes, you have to know the names. Even if you are not going to know everything completely, you have to know what article covers what. It's a requirement to pass your exam. So it means that if you don't know what is inside that article, not completely, but you know the name of the article and what it covers, and at least the taxing right, you should be fine. Do you get it? That is how it is supposed to be. Are we okay?
Okay, sure.
Right.
Yeah.
Is that the last question, or someone else has another question? Or we can proceed to the next session. All right. Okay, so the next area we have to look at, very broad area, is the relief from double taxation. So we have looked at double taxation. So we have to look at the relief from double taxation, because we realize that double taxation causes untold hardships, right? Because if you are paying tax twice, you wouldn't find it beneficial. You would want to escape taxes. That is why there's a need for the tax authorities to provide a system to relieve people from double taxation. All right. And then to relieve people from double taxation, there are two approaches. We have what we call the unilateral approach. You see, the word there is uni, meaning one, right? So unilateral means we relieve people based on the provisions in our domestic law. Okay. We relieve people based on provisions in our domestic law only. It means that we do not need any other person to. So assuming Kofi paid tax in the UK, based on some rules, if Kofi comes to Ghana, we will look at the provisions under Act 896 and then find a way to reduce the tax Kofi will pay on his worldwide income. Do you understand? So based on it, we don't consider the DTAs. The second type is the bilateral, right? There's the bilateral approach. And the bilateral approach is where we use DTAs, all right? It's where we use DTAs. So we have two approaches to relieve people from double taxation, right? Which is what? Unilateral approach and then bilateral approach, okay? So this is the first type of question, the approach for relieving people, okay? So the next thing is, why do we relieve people? So why should we relieve people from double taxation? So why should we relieve people, or why should we relieve persons from double taxation? Why should we relieve persons from double taxation? Okay, or reasons for relieving people from double taxation. And this to achieve something we call tax neutrality. So remember I told you, when we get to some point, we talk about tax neutrality. So we want to make sure that at the end of the day, the person, okay, would still be able to pay the necessary amount of tax, okay, and be satisfied, and the government will also be satisfied. So it means that at any point in time, if I should pay tax, I will be willing and able to pay that tax, and government will be willing and able to accept that tax without any conflict. So there'll be neutrality in the tax process, okay? So there are three types of tax neutrality, okay? And it is based on what? Either what we call capital export neutrality, capital import neutrality, and what we call national neutrality. Let me explain. You see, these things I'm saying, they look like I'm just teaching you theories, but they are all past questions. It's funny, eh? Yes, you can go to the exam and they'll just ask you what these things are. Let me just show you something. I just want to give you a preliminary or just a preview for you to see something. I hope you can see my screen.
Yes, the same screen.
All right. So see, question 1. You are to write a report to your manager as a tax expert on double taxation, its connecting factors, causes and relief from double taxation. Have we not learned this? Answer me.
Yes, we've done that.
So what is double taxation? We know. What are the connecting factors? Yes, what are the connecting factors that lead to double taxation?
Source residence.
Residence principle
And the
source principle.
Okay, what are the causes of double taxation? Residence conflict, source residence conflict, source conflict, not so. And then relief. We are now looking at relief. And this is a full 20 marker. 2, explain the 2 types of double taxation and describe how double taxation can be relieved. You know them, right? What are the 2 types? This is another
Economic and
50
juridical.
mark.
Economic and juridical.
Now, the next type of question says what? Differentiate between economic and juridical double taxation and describe how each of them arise. And these are frequently popping up almost every day. So I only teach you what you need for the exam. Nothing more. Something more, nothing less. Sometimes I end up going beyond that anyway. But you get the idea. So now look at another exam question. It says what? Describe 3 ways of relieving double taxation, possible disadvantages of them. So the various methods, right? Which we'll come and look at. Now, look at this question. State and explain the main purpose of relieving double tax. Okay. And we just look at the reasons or the purpose of relieving, right? So it should be addressed with the following concept: capital import neutrality, capital export neutrality, and national neutrality. So you see, everything I'm teaching you is actually a question that they can ask you. Makes sense? So take it very, very serious. All right. So why should we relieve people from double taxation, or what are the reasons? And I said it's to achieve tax neutrality. And I gave you the types of tax neutrality. What are they? What are the types of tax neutrality I gave you? 3, right? So either to achieve what? Capital export neutrality, capital import neutrality, or national neutrality. All right. So let's look at them one after the other. So capital export neutrality is simply to make sure that no matter where you go and pay tax in the world, if we bring all together, it should still be equal to the tax you would have paid in your home country if you never left. Wow. And still earn that same income. So instead of just explaining by word, let me use an illustration with Kofi, right? So let's understand. And this one supports what we call the credit method of relief. So there are 3 types of reliefs. There are actually 4, but there are 3 types of relief that these ones based on. So to relieve people from double taxation, that's what we call the credit method. After this, we'll come and understand them, right? That's what we call the exemption method. And there's what we call the deduction method. Okay, so these are but there are other ones. There's another one which mostly we use to attract investment. We call it the sparing credit relief. Okay, the tax sparing credit. Okay, but these are the common ones that you see. All these ones are based on the credit and exemption. Now look here. So this capital export neutrality supports the credit method. What did I say? It supports what? The credit method. The capital import neutrality supports the exemption method. So let me just give it to you straightforward so you know each of them are linked with a particular method. So the credit method was created because of capital export neutrality. Okay. The neutrality. Okay. That's the exemption method. So here it's connected with the exemption method. And then national neutrality was created to achieve what? Or the deduction method is connected with national neutrality. So I told you here, no matter where you go in the world, assuming you never left and you make that same amount of money, you would end up paying the same tax as you would have paid worldwide. Let's see. Assuming Kofi, we know that Kofi went to the UK. How much did he earn? He earned business income of what? £100,000, right? So let's see. And then he paid tax in UK at 20%, not so. Okay. So we said he paid tax at 20,000, not so. Okay. So he would have made what? 80,000 net. Okay. Now, if I come to Ghana, I have to bring my gross income that I made, right? So the whole 100,000 will be brought to Ghana. Also, now it will be taxed at what? 25%, which would have been 25,000, right? But if I'm supposed to give this guy a tax credit, if I'm applying the credit method, right? And I give him a tax credit will be given for the tax that you paid in the foreign country. Okay, so that 20,000 you paid in the foreign country, that 20,000 will be given as a credit for you. So you end up paying a net tax in Ghana of how much? You end up paying a net tax in Ghana of about what? 5,000. So in actual sense, your total tax liability would have been what? You paid how much in Ghana? You paid 5,000 in Ghana, and then in the UK, you ended up paying what? 20,000. Not so. So at the end of the day, you end up paying 25,000 overall. Not so. Okay. Assuming Kofi never left Ghana, and he earned that same £100,000 in Ghana, he would have paid 25,000 exactly, which means that we have achieved capital export neutrality. This person wouldn't want to not bring his taxes to Ghana because whether he left Ghana or not, he would still end up paying the same liability to the extent of the domestic law, right? So that is what we call capital export neutrality, because if he never left Ghana, he would have only made 100,000 and he would pay 25,000, right? No credit. Now he left Ghana, went to pay tax of 20, and because of that, he's only paying 5 in addition, meaning that because of the credit method, this guy ended up paying 25,000 as if he was only in Ghana. Did that make sense? Did that make sense?
Yes, it did.
Yes, sir.
Okay. So, assuming you never left, so this encourages people to bring more things to Ghana, right? To bring their money to Ghana, because whether they left or they didn't leave, their tax liability will still be at the same level. Do you understand? All right. Now, that was capital export neutrality. Let's come simply saying that, okay, we should be taxed on the same base with a non-resident person. What does that mean? It means that you see mostly the tax base of a resident person is the worldwide income, true or false? But the non-resident person is only on the source income. Is that not what we learned? Residents are taxed on their worldwide income, and non-resident worldwide income. Please, if you are using 2 devices, just lower the volume on the other device completely. Otherwise, there will be feedback. Please, if you are using 2 devices, just lower the volume on that. lower the volume on the other device completely, off one, the volume, then you will not get this feedback. All right. So this is what we are saying for capital import neutrality. We are saying that we are going to make sure that both residents and non-residents are only taxed on source income, which makes it fun because if I go and make any money from London and I bring it to Ghana, that money will not be taxed. But me and a non-resident will only be taxed on our source income, making it nice for me to bring money to Ghana. Because if I bring money to Ghana and I know that that money will not be taxed in Ghana, won't I be happy? Meaning I'll only be taxed on income generated in Ghana. So this method encourages the source principal taxation because we exempt the foreign income from tax. Did that make sense? So you see, everything is just to achieve some sort of neutrality, to sort of relieve the taxpayer in some way. Did you get the whole idea? So we are saying that, okay, now, using this principle, it means that if Kofi were to come to Ghana now, okay, this is what will happen if we are doing capital import neutrality. It means that Kofi will be exempted from the foreign tax that he paid in Ghana. So this is how it will be. It means that if this is the UK, right, we know that his business income was what? £100,000. He ended up paying tax at what? At 20%. So pay 20,000. So this gives us a net of what? 80,000. Okay. Now, if he comes to Ghana, he brings that same income, right? That same gross income, which was £100,000 to Ghana, right? But here lies the case. There's no income tax, right? It's tax exempt. So that means the income that he brought in Ghana is not taxable. So in effect, his total tax liability is only the 20,000 he paid in the UK. Wouldn't this guy be happy that, oh, baby, that's the only tax you have to pay? Do you get the idea? So this one is sort of what? Making sure that, assuming Kofi has earned another extra 50,000 Ghana cedis in Ghana, then this is the only one that will be taxed under the Ghana law. But any money you brought from a foreign country will be exempt from tax. Did that make sense? Did that make sense?
Yes, sir.
Yes, sir.
Means that the whole income will be exempted from tax. Do you get it? That is why it achieves capital import neutrality. These things, when you read them in books, you will not understand it. That's why I brought it to your level. Does that make sense?
Yes, sir.
All right. All right. Can we go? So let's look at our good friend, national neutrality. Now, national neutrality is to protect government revenue. So we do it to protect government revenue, and that's the only thing we can do is that we will not give you a credit, we will not give you what? An exemption, but what we will do is that we will give you a deduction for the foreign tax that you paid, okay? And how does that happen? We know that for the exemption and the credit method, you get huge reliefs. But with this national neutrality, it is to protect national revenue. So the only thing we do is to give you deduction. Hardly do you get a deduction for taxes paid, right? But then that one, it is the least lenient approach, but we give you a deduction for the tax you paid. If we take the case of Kofi again, right? Let's take the case of Kofi again. It means that using the case of Kofi, if he was in the UK, how much did Kofi make in the UK? His business income was what? £100,000, right? Okay, then take out the 20,000. Means his net income is 80,000, which he will now come to Ghana, right? If he comes to Ghana, the gross income of that same 100,000 will be brought to Ghana, right? But here, what happens is that you don't get a credit, you don't get an exemption. You can only get an allowable deduction, right? A tax deduction for that tax you paid. So in that case, this 20,000 shall be treated as a tax expense, okay, which is allowed by the tax law. So under the tax law, we can deduct what? The 20,000 from our income, and then we have our chargeable income in Ghana. So in Ghana, taxable income is called chargeable income, which now gives us what? 80,000. So now, in actual sense, we are now going to tax 80,000. So due to be what? Tax at 25%. So that means we pay an extra tax of what? 20,000, right? So in that case, our total tax liability becomes at 20,000 that was paid in the foreign country, plus the 20,000 that was paid in Ghana. So we end up paying what? 40,000. And you see, this is the less lenient approach. This one made us pay more, because when you look at the credits method, which was capital export neutrality, right? We ended up with a total tax of only 25. Then we came to look at capital import neutrality. We ended up with a tax of only 20 because we exempted the income from domestic tax. But with national neutrality, because we want to protect domestic tax revenue, we ended up paying a total tax of 40,000. So I believe you have seen this. So these are the reasons why we relieve people, and through that you have learned the various methods. So the credit method, exemption method, and the deduction method. And you know, these things that we have done can come as a full question where you have to apply all the methods. Let me show you. Look at the question before you. A company resident in country A, where corporate tax is 30%, has a branch in country B. The corporate tax rate in country B is 35%, and the branch makes a chargeable income of 200,000, right, Ghana cedis, in the 20XX year of assessment, right? Illustrate by calculations how any double tax will be relieved by each of the three methods of double tax relief. 6 marks. Calculate the effective tax rate if there is no relief, and if each of the three methods of tax relief is applied, right? So all you are going to do is you do no relief, deduction, exemption, and then credit, right? So you create columns and then you do all of them. So we are going to just look at, so he's resident in country A, that's the resident state, and then he went to country B, right? So it's 200,000. Let's see if we apply either methods, how would it look like? So it's just like Kofi's case, we can still do no relief. So assuming I'm applying the same thing for Kofi, right? Let's just use Kofi's case, which is better, right? It's the same question anyway. So in Kofi's case, just as a summary, when there is no relief, when there is what? Exemption. When there is what? Credit. And when there's deduction. Do you guys remember? Exemption, what neutrality does it achieve? Exemption method.
Capital import.
Capital import. Okay. Credit.
Capital export.
Deduction.
National neutrality.
National neutrality. Okay, so here, UK, right? So this is UK. In UK, what was his taxable income? How much did he make in the UK?
200.
Sammy, you are using two devices. Lower the volume on one completely. Just kill the volume on one. That feedback will not come. Okay? Please.
Yeah. Okay. I'm using one device, but I'll check my.
That means you have either. I'm trying twice. So taxable income, let's assume it was equivalent of 100,000, right? So in the UK, you would have earned 100,000 throughout, right? For all the methods. All right. Now we will tax in the UK. We would have taxed you at what? Based on the question I gave, 20%, right? For Kofi. So 20%, meaning you would have paid tax of 20,000, which is inevitable, right? You should understand that it's only the resident state who can give you a relief. What did I say? Is what? It's only what? It's only the resident state who can give you a relief. So this tax you paid in the UK, whether or not we give you any relief, you will still pay it in the UK because you have generated it from source, right? The UK is the source state, which is using source taxation. So if there's no relief, it means that your net income from the case of the UK is equivalent to what? So you would have had 80,000 net, 80,000 net, 80,000 what? Net, right? All right. Okay. So that ends the case of UK. Now we come to Ghana, which is what? The resident state, right? We come to Ghana, which is the resident state. So in Ghana, let's bring our gross income. It's always a gross. I told you, once you are resident, you are taxed on worldwide income. So in Ghana, what happens? We bring the whole 100,000 he earned, not soon, irrespective of, but because it's exempt in Ghana, it's nil, right? Exemption. Credit, we still bring the whole 100,000, not so. Deduction, we still bring the whole 100,000. Exemption, we exempt the whole income from tax. So this gross income, remember that under the deduction method, you get a deduction for that income. Do you remember? For the tax that you paid. True or false?
It's true.
So that one will be a deduction against your income. But for all other methods, you don't get any deduction. So it means that your taxable income, not so, will still be 100,000 when there's no relief, not so nil. This is still 100,000, but for the deduction method, you are taxed on 80,000, not so. Okay. Then now we calculate his tax payable. Tax payable in Ghana is 25%. So 100,000, no relief, you pay tax of 25,000 also. Okay. So here too, you pay tax of what? 25,000. But here, no tax. Now so here too, he'll pay tax of what? 20,000. All right. But this is the only one where he's going to get a tax credit, right? Under the credit method. So you get a tax credit. And the tax credit is the foreign tax credit, the foreign tax that he paid, right? We'll give it to him as a credit. And that is the what? The 20,000 he paid here, right? It will be given to him as a credit, deducted from that income. Remember, okay? So he'll end up with net tax of how much? Of 5,000, right? So in that case, the total tax liability from each of them is that this guy will end up paying a total tax of 45,000. Do you all agree? Because he paid 20 in the UK and came to pay 25 in Ghana. No relief. Makes sense? Makes sense?
Yes, sir.
Now, under the exemption method, he paid 20 in the UK and paid nothing in Ghana. So his total tax liability is just 20,000. Under the credit method, he paid 20,000 in what? In the UK and came to pay what? 5,000 in Ghana, making his total tax liability 25,000, right? So we come to what? The last one, where he paid what? He paid 20 in UK and paid 20 in Ghana. He ended up paying a total of what? 40,000. No, so that tells us that what? Which one is the less lenient one?
Exemption method.
No, the less lenient, the one which is more, which makes you pay more. Exemption is
no relief.
No relief. No relief is double taxation, right? I'm talking about the one which less lenient. The one which is very is this one, the deduction, because
Yes,
you're paying, even it's a relief, but you're still paying 40, meaning in fact they've only relieved you of 5,000. And why do they do that? It's to achieve what? National neutrality, to protect national revenue. Is that not what we learned?
Yes.
And this is the whole question. We just saw a similar one. And this is all you have to do to get your marks. Okay, so in actual sense, the effective tax rate here was, I had effective tax rate is just your tax over your gross income, right? So in actual sense, the total tax you ended up paying here was 45,000 over the gross income of 100,000. So in effect, the effective tax rate here is 45%. Wow, that's very high. You can see. What about here? The effective tax rate to be 20,000 over the overall income of 100,000, which is about what? 20%. Here, the effective tax rate to be a total tax of 25,000 over the 100,000, which is about what? 25,000. And here, it is 40,000 over what? The whole 100,000, which is equivalent to what? Equivalent to what? 40%, right? So looking at all the reliefs, which one has the highest effective tax rate? The reliefs, I'm not talking about
method.
The deduction method. And it is to achieve what? National neutrality, right? Makes sense. This one is to achieve what? Capital export neutrality. This is to achieve capital import neutrality. I never understood this thing when I was taught in class, but I hope I've simplified it to your level.
Yes, sir. Thank you.
You are warmly welcome. So now we have seen why we relieve double taxation, but we have also seen the methods too. But let's dive deeper into the methods a little, right? So let's go into the methods a little for you to maybe appreciate them a little, right? That's what makes them interesting. Yeah. Where were we? Where were we? So we understand how the methods work, don't we?
Yes,
Yes, we do.
About the credit method a little, right? Because the credit method actually has some things you have to understand. The credit method has sub methods, just as the other one. What is the other one we talked about? The deduction method also has some rules. So they said describe 3 ways of relieving double taxation, possible advantages and disadvantages of them. And these are typical exam questions. Okay, so the 3 ways are credit, exemption, and deduction. So the credit method is dealt with under the DTS under Article 23B. In Ghana, we deal with it under Section 112 of the Income Tax Act, right? So after that, I'll take a simple question and teach you how the credit method is dealt with, okay? So this one relieves the taxes paid at source in the resident jurisdiction. I told you it's the resident state that can give you what? That can give you what? The credit. So with this type of the resident country provides its taxpayers with a credit against taxes otherwise payable for income taxes paid to a foreign country, all right? So it takes 2 forms, which is a full credit relief, where the resident country, for instance, Ghana, relieves 100% of the taxes paid by Kofi in the UK. Do you get the idea? I'm just using our same example so that it makes sense. These things are practical. Do you get the idea? Then we have ordinary credit relief. And this ordinary credit relief is where the resident country relieves the taxes paid at source with the maximum that it would have been resulted if the income was obtained in the resident country. It works with a cap. So what it means is that, you see, Kofi, look at this. You realize that Kofi went to pay tax of 20% in the UK. Do you remember? And Ghana's tax was 25. So you realize that we were able to deduct the whole 20 from the 25. True or false?
True.
True or false? Because there is the maximum. So Kofi a full credit. What if Kofi pay tax of 25% in the UK, which is equivalent to the same 25% in Ghana. We can still deduct 25 from 25, right? So we still give Kofi a full credit. But what if Kofi want to pay tax of 30% in the UK? The maximum deduction you can get in the Ghanaian tax law is 25. So that means we can only count it to what? To 25, because Ghana cannot give you something beyond its law. Meaning Ghana can only get here 25. It means the extra 5% that you incur is your own cost. Smile say, go and invest in a country that has more tax than the Ghanaian law. So this is what we call the ordinary or limited credit, right? So it means that this credit is only limited to the extent of the maximum average tax rate in Ghana or the other country. So you get the different types of credits that we have. Did you get it?
Yes, sir.
So
Prof, question.
Yes, boss.
Yeah, please, the ordinary credit relief, can it be called a partial credit relief? Is it the same thing?
Yes, the same. It's a partial credit.
Okay, thank you.
You're welcome. Do you get the whole idea? So it means that so far as what you paid in the foreign country or the source country is more than what the resident country has, it will be limited to what the resident country has. Makes sense? So these are the two types of credits that we have. So why the credit method? It is more neutral between countries that operate abroad and those that only do domestically. Only if the source country has what? Lower taxation rates, it is better because you end up getting spared of the property tax. When the source country has higher tax rates, then the resident country may allow to carry forward or back the credit. Some countries do that, right? Where you can carry forward or carry back credit. In Ghana, we do relinquishment, okay? I'll come and show you, that's deduction. Then it allows to include tax losses in the resident company's tax basis. Sometimes, depends on Ghana, we don't have that provision. The tax authorities can also see where companies get their profits from. So this one helps us to what? Know where to allocate our tax audit resources. Okay, so it usually depends, right? These are the merits of the credit method. All right. Did you understand the merits, or it's not clear? I believe it is, right? So that we move on.
Yes, it is.
What's it? All right. All right. So what are the demerits? Because this one, you have to apply to GRA and all that. You see, it requires a lot of administration or a lot of administrative work to be done, right? Papers, getting a tax certificate from another country, proving your residence and all that. So it can be quite cumbersome to apply, right? And sometimes claiming that credit, assuming the other countries tax rate is greater than ours, will require a limitation, just like we saw, right? So that was the credit method. Now we get to the exemption method. Now, this method is dealt with under Article 23 of the DTAs, and then in Ghana is spread across, right? There are various sections of our law that deals with exemption from foreign income. I can give you a lot. We can visit Section 7 of Act 896. We can visit Section 111. We can visit, there are a lot of them spread. Section 47, Section 62, plenty. I can't mention all of them, but you know, plenty. Section 107 talks about exemption from PE. So there are a lot of exemptions spread, even Section 7, subsection 1P. What do we call it? Shipping and air transport businesses, right? There's exemption from non-resident if they engage in government bonds, if they buy government bonds, right? So there are a lot of exemptions under our law. So the exemption method is spread all across our act, exemptions, right? Now, it focuses on the profits obtained by a subsidiary abroad most of the time. That is what we'll be using. And it focuses on income and not the taxes paid. So, you know, the credit, we gave you credit for the taxes that were paid. But for exemption, it is the income that is exempted, not the tax. So get a rule. This one, the whole income is exempt from tax. But with the credit method, it's the tax that is relieved. Here, the income is not taxable, but the credit method is the exemption method is the income that is relieved from tax. Did that make sense? Are we okay?
Yes,
Now,
sir.
this will only be available for certain types of income. So when exemption is not available, then credit relief must be given. Okay, so sometimes some exam questions work like that. Okay, so there are some incomes which may have exemptions and may have credit. So when exemption is not available, then we must give credit. So with this type of relief, the resident country provides its taxpayers with an exemption for what? Foreign source income. And it is always limited to some types of income, like we saw in Kofi's case. You saw that the whole income was what? Exempted. And this is to achieve what type of tax neutrality? What type of tax neutrality do we achieve in this one?
The import.
Capital
Capital
import neutrality.
Yeah, that is it. So there are various types of exemption. We have a full exemption where the whole income is exempted. We have partial exemptions, right? And those exemptions can be categorized as either participation exemption or exemption with progression, all right? So let's get into it. Now, with participation exemption, mostly exists for capital gains and dividends, mostly for passive income. And this one, the word there is participation. It means that you must get some condition. You must participate to enjoy that exemption. So it is a system for capital gains and dividends. I get it. That are only available for qualifying shareholding. So the conditions is that one, the income should have been taxed as source. So relevant taxation rates may be needed, right? So mostly in the DTAs, like when you have a minimum shareholding of 5%, and your shares are not trading stock, right? There are shares that are maybe available for sale, like you're holding it for the long term and you don't wish to convert immediately. Okay, so when these criteria are met, then you get it. In Ghana, I can make specific references to section 53, section 59, subsection 3. You must get that percentage to participate in that exemption. And then section 47, you must what? Get that percentage to participate. Do you get it? So I'm giving you typical real life examples. So let's visit section 59.3 and let's see what it means to get that participation. That's an example. There are a lot of them, but I only want to make reference to the common ones. Now, under section 59, taxation of shareholders, let's look at the subsection 3. I want one of you to read that for me. Just read this statement for me, and then you understand why. Yes. Quick. We have less time.
A dividend paid to a resident company. A dividend paid to a resident company by another resident company is exempt from tax, where the company that received the dividend controls indirectly or directly at least 25% of the voting power of the company which paid the dividend.
So you see, this is the participating exemption. Does it make sense to everyone? Meaning that if you're able to participate in at least 25% of a company's voting power, then if that company pays dividend, it will be exempt from tax. Did that make sense to everyone?
Yeah.
Yes, sir.
Yes.
Yeah. One of the participating exemptions. This rule does not apply to redeemable preference shares, neither does it apply to petroleum and mining companies. Okay, so when you are doing oil and gas, remember, because they bring it nowadays in most of your questions to check if you know this provision. And since you are dealing with mining and petroleum companies, even if you see it, you just make a note on it and tell the examiner that this provision does not apply to petroleum and mineral companies. Makes sense. So that's the first participating exemption. Have you written it down? Section 59.3. All right. So we go to section 47. All right. Let's go and look at section 47 of the Income Tax Act. Okay. Look at this. It says what? Realization of asset by way of merger, amalgamation, or reorganization. Now, the gains on realization of an asset accruing to or derived by a company arising out of a merger, amalgamation, or reorganization of a company is exempt from tax, right? Where you meet the participation, where there's continuity of at least what? 50% of what? Underlying ownership. Can you see? So this is the participation. If you sell your company and still maintain 50% or more of the original ownership, it means that that transaction will be exempt from tax. I hope now you're understanding participating exemption. And you see it, we only saw it for capital gains, that's realization, and dividends. True or false?
True.
Did it make sense? I'm sure it made sense to everyone, right? All right. So what we do now is to go back and understand what we mean by what? Exemption with progression. Exemption with progression is straightforward. This is what it means. You have brought some income to Ghana. We must first go and check our domestic law. If that income is actually exempt in Ghana, then we exempt you. Did it make sense? So you brought business income from shipping to Ghana. We must go and check at 896 to see if shipping income is exempt from tax in Ghana. Then we exempt you. Did it make sense?
Yes, sir.
Yes, sir.
So that some countries may apply the exemption with progression. And this is the income abroad, right? With this one, the income abroad will be considered at the resident level to assess the taxation rate of the resident company. So we will still include the income, but at the resident level, we will check if the income is actually exempted, and then the income will be exempted. That is how it works, right? So this is the exemption method, and then this is how it works. We've seen the calculation already, but you've seen how it works. So it is the simplest method to administer, the exemption method, right? Because that one, you just exempt the income. And the method encourages companies to invest in jurisdictions with lower tax rates. Okay, so do you know what happens? This guy, look at this. Some people end up taking advantage of this position, right? Look at this. Assuming I invest in Mauritius and I end up paying tax at 5%, okay? Have I not paid lower tax already? Now, if I bring this income to Ghana, the whole income will be exempt from tax. So I should have paid tax of, let's say, 25% in Mauritius, but only paid 5%. And then I came to Ghana to is exempt from tax. It means I've saved a huge amount of tax, right? Which is beneficial for companies. So anytime companies hear of exemption, they start smelling, right? They want to come and enjoy. So it attracts a lot of holding companies. And sometimes it allows companies to include tax losses at source in the resident company or the resident country, right? Some countries like France ignore losses in their exemption system. Okay. Even in Ghana to some extent, but don't worry about that. No one will go that far with you. Okay. So we come to the deduction method. Now, foreign taxes are treated as current expenses of doing business in a foreign jurisdiction. And this is the least generous method. We know that because it wants to achieve what? Why is the deduction method the least generous method? Because it wants to achieve what?
National neutrality.
And what is national neutrality? To protect what? I told you. To protect national what?
Interest.
National income.
Or revenue.
Yes. So that is why this one is the least generous method, because we need to make as much money as possible. Because this method is to support developing countries, make more money, it is not sanctioned by the OECD model. Do you get it? The OECD model doesn't really focus on it. It focuses just on the credit and the exemption method most of the time. But in the UN model, this method is there. Why? Because this method helps to protect national revenue, and that is what we want to do, help nations build income. But it creates bias in favor of domestic investment over foreign investment. So whenever the foreign investment is likely to attract foreign income tax, you still pay more tax. So with this method, the resident country allows its taxpayers to claim a deduction for taxes, including taxes paid to a foreign government in respect of foreign source income. So we have seen this method. Under Section 112, subsection 3 of the Income Tax Act, we dive into this, right? Relinquishment. Let's go and see. Let's see how relinquishment works. Section 112, subsection 3. I hope I'm not wrong. Yeah. A person may elect to relinquish a foreign tax credit available for a year of assessment and claim a deduction. And claim what? And claim what?
A deduction.
For the amount of income tax paid to the foreign country, but otherwise, the tax law does not allow a deduction for an income tax paid to a foreign country. So in Ghana, it means that so far as income tax paid is in a foreign country, or you pay tax in a foreign country, you can only get a credit or exemption for it. The only time a deduction is given is in the case of what? Relinquishment. When you want to kill the credit by opting for a deduction rather than a credit. Did that make sense to everyone? We sure? Yeah. We sure? So you want us to take a question?
No,
yes.
Sir, I'm not that clear. Hello, sir, please come again.
I said in Ghana, we only give you credit and exemption, except when you yourself opt for deduction. Then that foreign tax will be given to you as a deduction against your income. It means that you deduct it like the way you deduct your rent, your other business expenses, right?
Okay. Okay.
Is your question
answered? Yes, I'm okay. Thank you. Yeah.
All right. Welcome. Any questions so far? Or you believe we can take questions?
No problem.
Yes, please.
Yes, in practice, are we allowed to use both the full credit method and the partial credit method, or we are just limited to one?
Yeah. In practice, we use all.
Okay.
In practice, we use all. It depends on the nature of the credit. So if you went to another country and it is more than that, then you will limit it to your country's tax rate. Okay? It is like that. Now, let's look at this. Because we talked about relinquishment, let's see. That's the deduction method. Gani Limited is a company based in Ghana and has a business dealing mainly in Nigeria, right? In the 2020 year of assessment, the following data is relevant to parts of its operation. So it made global income, which is 25 million Ghana cedis, and it paid tax of what? 1 million naira in Nigeria. The exchange rate is one cedi to what? 67.59 naira. Gani elects to relinquish a foreign tax credit for the year ended, right? Required, compute the tax liability. And there's an adaptation from ICA, Advanced Taxation, May 2021, question 2D. So what did we say here? We said relinquishment means what? The foreign tax that was paid will be given as what? Will be given as what? Hey, the foreign tax that was paid will be given to you as what?
As a deduction instead of a credit.
Yes, so that means if we take the foreign income of 25 million, we will convert what? The naira to Ghana cedi and then claim it as what? A deduction. So we just claim that as a deduction and then what? We deduct it, less tax paid in Nigeria, we get our chargeable income, then we tax it. That is it. That's how relinquishment works. Did that make sense to everyone?
Yes, sir.
Yes, sir.
Are you sure? Are we sure?
I'm very sure.
All right. That is fine. So now I believe nobody has a problem with the methods of relief. I think you guys are fine. All right. So, yes, boss.
Is it practical? Is it practical that one will rather relinquish foreign tax credit for a deduction, since we know per the calculations we have done so far, the deduction method is the less friendly method in terms of, looking at the tax that will be charged to the taxpayer, or the tax that the taxpayer would have to pay. Is it practical?
Yes, it is. Why is it practical? Let me explain. Now, assuming this company we are talking about, right, has a lot of credits against his income, that it is ending him in a credit in another way, why wouldn't he claim a deduction rather against his income, his other types of income? Do you get what I'm trying to say? Assuming this guy has a huge withholding tax credit in Ghana, and that foreign tax credit is still against that income, then why would you worry yourself with a credit or an exemption? You can claim a deduction against your other incomes to reduce it to an acceptable level. You get it? That's from a tax planning perspective. Is your question answered?
Yes, sir.
Hello, Prof.
All right.
Hello, Prof.
Yes, boss.
Please,
Yes,
I'm pleading if you can use an illustration to or figures to explain the exemption rate progression. If you can use figures or an illustration.
So the whole thing is that we have done it, but you just don't know that's what we did. That income that Kofi made, right? That income that Kofi made. When you bring it to Ghana, you still include it in your income, right? And check the income that he would have paid, the tax that he would have paid, right? Assuming that income was exempt in the Ghanaian tax law, then what would he have also paid? That is the whole thing. So there's no need for an illustration. The income that you brought, is it taxable or exempt in Ghana? If we decide to exempt you and it's exempt in Ghana, then we exempt you. So why do you need an illustration again?
That's fine, sir. Thank you.
Sure. All right. Now we have seen that we have two main approaches for relieving people from double taxation. What are those approaches? What are the two approaches?
Two approaches that
we said unilateral,
bilateral,
bilateral,
and then what? Okay, so we saw these ones, right? Now we come and look at the other way of relieving people from double taxation, and that is entering into agreement with other countries, and that is the use of the double tax avoidance agreement or arrangement, and that is the use of the DTAs. Okay, that is using DTAs. Okay, now if you are using DTAs, what are DTAs? They are agreements or contracts regarding double taxation, or more correctly, the avoidance of double taxation. Okay, so this is an agreement between two sovereign states that are separate and distinct political entities, and we know that is what? Sovereign state, right? Because of what? Tax sovereignty. It has the status of a treaty. So its alternative name is what we call a double tax treaty. So a tax treaty, otherwise known as a double tax agreement, can be described as a bilateral agreement between two countries who are known as what? Contracting states. So with the aim of what? Ensuring that a resident of one or both of the contracting states is not taxed twice on the same income in both jurisdictions, or unduly benefit from not paying appropriate taxes in any of the countries through tax evasion or avoidance. The agreement covers taxes on income and capital only. Now, let me explain something here. DTAs have two main objectives. There are a lot of them, but two main objectives. One is to reduce double taxation or minimize double taxation, and two is to prevent fiscal evasion. That is what? Cross-border tax evasion and avoidance. Do you understand? So it means that if I enter into double taxation agreement with Italy, it means that what? I want to do two things: relieve people from double taxation and control what? Tax avoidance and evasion. So some people prefer not to pay tax in Nigeria and will not want to pay tax in Ghana as well. Do you get it? Double non-taxation, which is tax evasion. Do you get it? So there are some countries that Ghana has DTAs with. We'll come and look at them. I usually use, there are other ones that they are finalizing, fine banks plus MMCS, right? That's how I remember this. I remember those days. Okay, so we have France, Italy, Netherlands, Denmark, Belgium, UK, Germany, South Africa, Switzerland, Morocco, Mauritius, Czech Republic, and then Singapore. These are the finalized ones that are effective. Okay, there are other ones that are coming. Okay, so France, write it down. France, Italy, Netherlands, Denmark, Belgium, UK, United Kingdom, South Africa, SA, Switzerland, Mauritius, Morocco.
Yeah, Germany. You let the Germany out.
Where is it? The J is supposed to be here. Germany. That's the J here. Mauritius, Morocco, Czech Republic. And then Singapore. Are we okay? And these are all full DTAs. Have you written them down? Have you written them down? Can we move?
Yes, sir, we can move on.
So the objectives of DTAs, we have already talked about them, right? So to minimize double taxation, remove tax obstacles and distort cross-border trade and investment flows, and maximize global wealth by ensuring an efficient allocation of resources. But we said the main objectives are what? Two: minimize double taxation and what? Deter fiscal evasion. So how do tax treaties achieve those objectives? They eliminate the most common forms of juridical and economic double taxation. They eliminate or reduce some taxes that would otherwise be payable by foreign investors. They eliminate some form of tax discrimination. They provide standard set of rules for dividing revenues between countries. They address tax evasion and avoidance. They provide a framework for settling tax disputes. Do you remember the mutual assistance in tax matters? The non-discrimination mutual agreement procedures, exchange of information. These things are always for settling disputes. Provide a stable tax environment for foreign investors. It also protects shipping and air transport businesses by giving them exemptions, and it increases international competitiveness of the economy. This can also be used as the advantages of DTAs. So Ghana's DTAs with other countries. So I've given you all of them with their various dates, right? Okay, so we have seen all this. But what are the disadvantages of double taxation agreement? Now, many agreements bypass the national law. Do you remember we talked about that? And I told you that that is one of the secrets for passing international tax. The Section 98(1) of the Revenue Administration Act. Do you guys remember? That says that where there's a conflict between what? The domestic law and the DTA, which one shall prevail?
The DTA.
The DTA.
Say the DTA shall what? Prevail over the domestic law. We looked at that, right? And because of this, sometimes it leads to loss of revenue. That is why it favors only capital exporting countries. Countries that want to favor national neutrality usually have a problem because the DTAs mostly bring only the credit and exemption method, right? And particular attention should be paid to time periods between creating permanent establishment. There's an issue there because the DTA may say 9 months, like the Germany example I gave, but Ghana law is saying just 90 days, which can be a problem, meaning it takes a longer time to create a PE. And when you are dealing with international, multinational companies, you have to do reviews on a country-by-country basis. Hence, destroying tax advantages that you can get on a group basis. Because if all the group has 20 plus 30, 20 plus 10 plus 20, this is 50 million, right? Assuming we want to go for finance, and they say we should get at least 40 million before the finance. But because we do reviews on entity by entity, maybe this entity will only be assessed on 20, meaning you cannot get the finance, right? Meaning that you lose some tax advantages when we are considering a review on individual basis. Now, how do we classify DTAs? As I told you earlier, DTAs may be classified based on the scope, that is what is covered in the DTA, or classified based on the number of parties to the treaty. All right. So a DTA that is categorized by scope can be a comprehensive DTA or a limited DTA. So a comprehensive DTA is the one that provides for taxes on income, capital gains, and etc. So they are full DTAs that ensure that taxpayers in both countries will be treated equally and on an equitable basis in respect of the problems relating to double taxation. So comprehensive DTAs covers all types of income and capital, right? Income to maybe shipping and net transport or estate or inheritance and gift taxes like the UK. UK has they have some DTAs which are limited, like they only cover specific incomes, not all incomes, right? Then we can also categorize DTAs based on the number of parties in the treaty. So it can be bilateral, which means that it is entered between two countries. And then we have what? Multilateral DTA. So multilateral is between a group of countries, more than two countries. So example is the convention between the northern countries. Okay, so Denmark, Finland, Norway, Sweden, those ICE-related countries. Okay, so those are the categories of DTA. I don't think this thing is that difficult to remember, right? So DTAs are classified as either full or comprehensive DTAs, limited DTAs, or bilateral and multilateral. Bilateral, two countries, multilateral, more than two countries. All right. Any questions so far, or we can proceed? Okay. So we look at the different models of tax treaties. I believe this thing, I have mentioned it before, right? So we have the OECD model, the UN model, and the US model. And I told you that the OECD model gives emphasis on residence-based taxation, and it is mostly for developed countries, okay? So developed countries adopted this model in case of treaties with other developed countries. So it started from 1963 draft convention, then it has now been regularly updated and amended, right? There's been amendments over the years, okay? Then the UN model emphasizes on source-based taxation. Why? To protect national revenue of domestic developing countries, to get more money for these developing countries, right? So developed countries adopted this model in case of treaties with developing countries or between two developing countries. So the OECD model convention has been used as the main reference document. So I told you that this is the oldest model, right? So anything that was formed was from this model. All right. So the US model is used by the USA for all its treaty negotiations. So this model has influence, are you getting it, on existing treaty between India and the US. Okay, that was where it started. Then the OECD model convention has been used as the main reference document as well. Are we okay? But Ghana, we don't have any DTA with US. So our focus in the exam is between OECD and UN. That's your exam focus. Okay, so we have now seen the different types of DTAs. Now we have to look at the standard chapters and articles of the DTA. The DTA has 7 chapters, right? So the first chapter is the scope of the convention. Okay, so the model tax convention of DTAs, they look like this. The first chapter is the scope of the convention, and then it has 2 articles, right? Article 1 is persons covered. And this article identifies the individuals or entities to whom the convention applies. For example, the UN model states this convention shall apply to persons who are residents of one or both of the contracting states. So the whole thing is that the persons covered, it covers residents of either state or both states, right? Before you can enjoy a benefit in the treaty, you must be resident in either state, making it the scope. Then the taxes that will be covered. Mostly, it covers taxes on income and capital, right? That's the first chapter of the DTA that talks about the scope, what the DTA covers. The second chapter talks about definitions, and you realize that this one, I gave it to you as your question. I believe that was your question. Was it 2? Yes. That means every day, this area questions will be coming. So Article 3 is general definitions, which provides definition for terms used in the agreement. Article 4 is resident, which defines the criteria for determining residency. Article 5 is permanent establishment, which defines what constitutes a PE for tax purposes. And I told you, every single date, this thing will pop up, whether you like it or not. Makes sense? And next week, that's what we will be looking at. Now, chapter 3 talks about the taxation of income. And you realize that this part 2, I made it one question, and I broke it into what? Passive and active income. Do you remember? So this one is the various incomes and how they are taxed. So Article 6 deals with income from immovable property. Article 7 deals with business profits. Article 8 deals with shipping, inland waterways transport, and air transport. That is international traffic. Article 9 deals with associated enterprises. Article 10 deals with dividends. 11, interest. Article 12, royalties and fees for technical services. Now, you see that here they've been brought together. But under the UN model, the fees for technical services was Article 12A. A separate article was created for it. Then we have Article 13, capital gains. Article 14, independent personal services, only unique to the UN model, just like Article 12A, right? So we have all these articles. I believe you wrote all of them down. Now, this chapter, also known as the distributive rules, okay, specifies how income will be taxed, often using expressions like shall be taxed only in, indicating what? Exclusive taxing rights. So you must understand this. When we say shall be taxed and may be taxed, this is very important in understanding international tax. If we say shall be taxed, it means that it is only that country that has the primary taxing right. That country taxes that income, meaning the other country reserves its right to tax. So if I tell you PE shall be taxed only in the source state, it means that the PE shall be taxed only in London, for instance, but in Ghana it will be exempted. If I say may be taxed, it means that that country has limited right of taxing. It can tax or not tax, right? It's conditional. All right. Then the next chapter, which is Article 22, focuses on what? The taxation of capital. And the rule with capital is that wherever the income that is connected with the capital is taxed, that is how we tax that capital. Then chapter 5 of the DTAs talk about the mechanics or the mechanisms for relieving double taxation. And we've learned it, right? We have learned the Article 23A and 23B, which is, we talked about credits method and what? Exemption method. And even went into deduction. Then we come to our big guys. That is the mutual assistance in tax matters. That is what the chapter 6 covers. So non-discrimination, mutual agreement procedure, exchange of information, assistance in the collection of taxes. There's members of diplomatic missions and consular posts. A very small article, but you can look at it. Hardly do they examine that side. Okay, then Article 29, territorial extension, only present in the what? The OECD model. And there are some provisions in the US model, which is subsequent changes in law. We do not have it in the current models. Then the final one is entry into force and termination of the DTA. So we learn how a DTA enters into force and how a DTA is terminated. So these are the full 7 chapters of the DTA. Now, DTAs have something we call the protocol. Okay, the reason why I'm telling you these things is I'm going to teach you how we interpret DTAs right away. Okay, because this question will mostly pop up all the time before our very last session, and then we close. Now, a protocol is an integral part of the DTA, providing detailed explanations and clarification on the agreement provisions. This includes clarifications agreed upon by the contracting states and can include illustrative examples, right? So in Ghana, we have some. In other countries, we have some protocols, right? So they are like, they give further explanation to things that are in the law, right? That do not really require formal ratification, but they are formally binding on the parties, okay? So now, when it comes to interpreting DTAs, okay, there are various rules we must follow to interpret a DTA, okay? But remember I told you that there's one document we use for interpretation or dealing with treaties, and that's the Vienna Convention on the Law of Treaty, okay? And these principles guide the interpretation of tax treaties to resolve conflicts and ambiguities, okay? So there's the ambulatory approach to dealing with treaties. And when we get to Article 3, which is general definitions, because if you are interpreting, then there should be definitions supporting that particular article. Now, before we get to the ordinary meaning, the context of the treaty and other stuff, I want to talk about Article 3(2), which I told you is the ambulatory approach. Now, what we are saying is this: where a term is not defined in the tax treaty, okay? So assuming we cannot get a term in the tax treaty, then we must make reference to the domestic law for its interpretation. Did that make sense? So if a term is not defined under the tax treaty, then I say refer to what? The definition of that term in what?
The domestic law.
The domestic law. And if the term is defined in a non-tax law or non-tax section of the domestic law and a tax-related section of the domestic law, which one do we pay reference to? Which one do we give? Which one prevails?
The tax-related.
So assuming we are dealing with royalties. Royalties are defined under the Copyright Act, right? Let's see. And royalties are also defined under the Minerals and Mining Act. Which one will we take precedence for?
The Minerals and Mining Act.
Is related to tax. That is what we are saying, right? So this is another side of interpretation, okay? So when a treaty is also in 2 or more languages, we give relevance to all the languages unless the parties agree that we should give more importance to one of the languages. Do you agree? So these are just basic things you need to know for interpretation. And then the protocol can be a means. We just talk about protocols, right? Which is like additional interpretation, which is binding but may not be ratified. Protocols can also be a supplementary means. It can be an addition or an aid to interpreting treaties, right? Then finally, the OECD and the UN Model Convention. You saw that we talked about the OECD and UN models. We said that they are frameworks for preparing treaties. So assuming you want to interpret something based on a treaty, right, that came from the UN model, where is the best place to look for interpretation? Is it not the UN model? Is it not the UN model?
Yes, it is.
If I form something based on the US model, if I want interpretation, is it not good to look back at the US model?
Yes.
It is. So it means that these things I've talked about may be supplementary means of interpreting a treaty, okay? Apart from the normal rules we are going to look at, these are other ways we can help to interpret treaties, right? Statements by various tax authorities or meetings by the various countries. These are all secondary means. The protocols to the treaty, are you getting it? When a term is not defined, making reference to the domestic law, are you getting it? And making reference to the OECD and UN models. And I told you when a treaty is put into 2 or more languages, what do? We give relevance to what?
All the languages.
Unless the treaty partners say what? We should give primary importance to one of them. Makes sense? All right.
Yes.
So what are the principles of interpretation as stated in the Vienna Convention on the Law of Treaties? One is good faith and the ordinary meaning. Now, according to Article 31 of the Vienna Convention, a treaty should be interpreted in good faith, considering the ordinary meaning of its terms within their context and in the light of the treaty's object and purpose. So we are saying that if you are interpreting a treaty, interpret it in good faith. This thing is the basis for interpretation. And almost every night, interpretation of tax treaties come. Last night it came. Last 3 nights it came. So it's always popping up, whether you like it or not. So interpret it, but consider the ordinary meaning of the terms, which context they were used, right? And what is the object and purpose of this use? This means that interpretation should reflect the genuine intent of the parties that were involved, and terms should be understood in their usual sense unless otherwise specified. Are we okay? So this is the first and most important principle for interpreting tax treaties. The next consideration is the contextual consideration. And we said in their context, right? So the context for interpreting a treaty, first we must look at what? The text of the treaty itself. Okay, so this encompasses the main text, the preamble, the annexes, the protocols, I get it, related agreements. So any agreements made between parties concerning the treaty's conclusion, even if it's a different country, we can still make reference to it, right? Then other related instruments can be used as means of what? Treaty interpretation, right? So instrument created by one or more parties and accepted by the others as related to the treaty. So protocol and other instruments like attachments to the treaty and whatnot can all be considered as what? Contextual considerations for interpreting tax treaties. So when a term is not defined in a treaty, what do we do? When a term is not defined in a tax treaty.
So we can look for the definition in our domestic laws, especially those that
make reference to the tax related. All right, that's good. Subsequent developments. Now, additional factors to consider include when there are subsequent developments, right? Like when there are subsequent agreements, any new agreement between the parties about their interpretation or the application of the treaty can be aids to interpretation, and subsequent practices, like practices that have developed in application of the treaty, reflecting the parties' agreement on the interpretation can be used. And then relevant rules for international law applicable to the relations between the parties can be used. So there are so many, but the most important one is what? What we saw. Interpreting in good faith, and then what? The contextual considerations. Then there may be special what? Meanings, right? Terms should be given a special meaning if it is clear that the parties intended such interpretation. So this principle is used when a term is defined differently from its ordinary meaning by the treaty's context or intent. All right, so terms must be given some special meanings if only that is what they intended it to mean. Makes sense? So if it is defined separately or differently from its meaning, what did they actually intend it to mean? Okay, and there should be consistency with the shared expectations of the parties as well, right? So that was how to interpret tax treaties. So if you go, they'll ask you a general question. So you can talk from all perspectives, like what I taught you, and then you should be fine, right? But the most important thing is the first principle, which is what? A treaty shall be interpreted in what? Shall be interpreted in what?
Good faith and the conceptual.
So you also talk about the supplementary means like the OECD model, the protocols, all those things, right? And then you'll be fine. Now, before a DTA comes to life, there are some what? There are some principles that has to what? You need to follow. And there are some stages that we use to the life cycle of a treaty, right? So from the time we negotiate it to the time it is terminated, it goes through some stages, right? So a treaty goes through some stages. The first is what? Negotiation and authentication. Okay, so the negotiation stage of a double taxation treaty typically involves representatives from the Ministry of Finance, the treasuries or revenue authorities of the contracting states. And these discussions focuses on aligning the tax policy and the terms of the treaty. So here we negotiate. After negotiation, we authenticate. So once negotiations are complete, the text of the double taxation treaty must be authenticated to ensure that it is established as authentic and definitive. This is where we check whether it is in line with the provisions under the Vienna Convention, the OECD model, the UN model, whatever we are using, right? So once we negotiate, we make sure it is authentic, it is real, it is acceptable. I get it. The provisions are realistic. Then from there, we now sign the treaty. Okay, so the signing of the treaty marks an important step. So representatives from each contracting state sign the treaty, right, indicating the approval of the negotiated terms according to Article 18A of the Vienna Convention. So the signature commits the states to refrain from actions that would undermine the treaty's objectives until it is ratified. Okay, so ratification is a step on its own, okay, but sometimes they put it under entry into force. Okay, it could be a step on its own. So when you sign a treaty, it tells that we have agreed, right? So while we sign a double taxation treaty, it demonstrates that the state's agreement on the treaty's terms, and it does not automatically grant taxpayers the rights outlined in the treaty. Signing of a treaty doesn't mean you can start using it. A treaty must be ratified to become effective. So if it doesn't meet parliamentary or constitutional approval, you cannot start using it. So the most important date for using a treaty is the date of effective application, or the effective date, right? So a treaty will then enter into force. When we say a treaty has entered into force, it must first be ratified, okay, meaning you get either constitutional or parliamentary approval, and then there must be exchange of instruments. So ratification is that each state must ratify it, incorporating the treaty's provisions into its domestic laws. And it can be achieved either by direct incorporation or a specific approval, maybe by your parliament or by a government, or maybe by a council of states, or by the constitution, or whatever it may be, right? After that, we must exchange instruments to tell the other state that, okay, we have done this in our law. You too, have you done yours? Yes, I have done mine. Have you done yours? Have you gotten parliamentary or constitutional approval? So after ratification, the states exchange instruments of ratification, which formalizes the treaty's entry into force. And this process ensures that the treaty is legally binding on both states. So in practice, one state might exchange its instruments of ratification before receiving the counterpart from the other state, as I told you. So we must see that, okay, the thing we have done, this guy has also done it. He has got parliamentary or constitutional approval. Then after that, finally, the treaty becomes effective. Okay, so determining effectiveness. The effective date of a double taxation treaty is critical for both the taxpayers and administrations. According to the OECD Model Tax Convention, contracting states have the flexibility to decide when the provisions of the treaty will take effect. And this date can be before it is entered into force, or the same date of entering into force, or after the treaty entered into force. So the effective date is the date where we apply the treaty, and it can come before entry into force, after entry into force, or during entry into force. So these are the stages in the life of a double taxation agreement. But the whole thing is that, when can a treaty be terminated? When can a treaty be terminated? One thing you must understand is that a treaty makes provisions for its own termination. What did I say? A treaty makes what?
Provisions for its own termination.
So it means that before a treaty comes out itself, there's a provision in there that tells us how the treaty should be terminated. Do you get that the whole idea?
Yes, sir.
Yeah, so the whole thing is, if a treaty makes provisions for its own termination, there might be other procedures that also tell us how a treaty will be terminated. Do you get the idea? So there are other rules that tell us where a treaty will be terminated. Are we okay? So as I told you, a DTA makes provision for its own termination, and the termination is a formal act where one or both states decide to end the DTA. And it should not be confused with the more informal ways like when somebody didn't perform well, somebody breached an agreement, and so on and so forth, right? So termination may also occur in a more general and informal manner, where one state simply does not apply to the provisions of the DTA as the other state intended. So it means that, okay, I wanted you to do this, maybe not discriminate against my people, and you did. Because of that, I have to end the treaty. Okay, so where a formal termination is intended, the contracting state terminating the DTA must give a notice to the other contracting state of a certain period in advance of the termination date. And the date from which a DTA no longer has any effect, it's also specified in the DTA. So mostly when you look at the article, it will be like this. This DTA shall remain in force until terminated by a contracting state. So either contracting state may terminate the DTA through diplomatic channels by giving notice of termination at least 6 months before the end of any calendar year. Okay, so this is what you normally see. And in such event, the DTA shall cease to have effect as follows. They give in state A, this is what you do. In state B, right? So features of automatic termination. Both states have the right to terminate. And a notice of 6 months is generally required to be given. And the date of cessation could be as per term of the agreement between the treaty partners. So it means that there could be a formal termination where both parties intended, or an informal termination where maybe you couldn't perform your functions, you have changed your law without informing them, or you have breached an agreement, right? So these are the conditions under which a treaty is terminated. I know today I have bombarded people with so much information. So,
Yeah,
any questions for me?
yeah. The recording stop.
Yes, because we are done with the session.
So because of the network, some of this I didn't get it.
No
My
problem.
notes have some spaces. So what?
The video will
When
be shared.
Okay, when you finish, I share it in the group for us so that you'll be able to.
The
I want to
video is
catch up.
it's on your page. It was streamed live on YouTube. It's on your page.
No, I've not. Because I was following you, so I have not gone to the page.
Yeah,
I
I
was
mean,
writing, making notes.
your WhatsApp page is there.
Okay.
Yeah.
Hello, sir.
But make your Telegram page and be uploading them.
Hello, sir.
Yes, boss.
Sinabili, I was asking the book that you are using.